If we see inflation move higher, it really calls into question Powell's willingness to say rate cuts still are coming.
It wouldn't take much, I think, to push back at least the timing of that first potential rate cut.
They're telling you if things slow down, they'll cut a lot more. So they're trying to say that the risks around those 3 cuts are balanced.
It's clear that this is a Fed chair that wants to cut rates and is willing to look through some of the hot inflation data.
I think we will end up with 2 cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, kicking off the week with yields at new highs for the year right across the curve. 2-year, 10-year, 30-year. Here's the state of play right now this morning. Yields higher by 4 basis points, very close to 4.45 on a 10-year. Lisa, going into inflation later this week, your 2-year approaching 4.80.
People are now pricing in basically 2 rate cuts from 3 rate cuts from 7 rate cuts earlier in the year in terms of what the Fed is going to do this year. What I'm looking at right now is how much does it matter and how much does this really speak to concerns about inflation or a real yields narrative? And I know it's nuanced, but this is something else. This is basically the Fed fighting inflation in the short term and winning over the long term, which just gives fuel to risk assets.
Post payrolls on Friday through the weekend, there was a dominant phrase in all of the Southside research, non-inflationary growth. How much of that story can we embrace going into this week?
We will find out on Wednesday with CPI. We will find out on Thursday with PPI. We will find out as we hear about the geopolitical backdrop in terms of tariffs and other such things. This really is the key question. Can this growth truly come without inflation? And is it sort of a justification for any rate cuts at all this year? If there are no rate cuts, does that mean that there are going to be fewer rate cuts over 2025 and 2026? Or, as the market is suggesting, does that mean there'll be even more in 2025 and 2026? So, oh yeah, okay, risk on.
You mentioned the geopolitics, so let's take the temperature of that, and we can do that in the commodity market. So let's bring up Brent and bring up WTI. WTI through Friday on a 6-day winning streak. Quite a rally last week, higher by 4.5%. This morning, Annmarie, we're lower by about 1%, still 90 on Brent crude.
Yeah, a little bit of cooling off in the oil market, and this has to do with the fact that Israel has taken some troops out of Gaza, but the issue is they're waiting for potentially this strike from Iran somewhere within the region or somewhere on Israeli foreign territory abroad. So Goldman Sachs is talking about the fact that the rally could go to 100 barrels should we still have that geopolitical impact continue. But that remains to be seen at the moment. Then you have a lot of supply constraints around the world, which Amrita Sen talked about a lot this week.
What I find fascinating was over the weekend, the notes that I read had more to do with the Saudi Arabian break-even rate, where they would actually have their positive returns on some of their funds. And it was $85 a barrel. So this is talking about a structurally higher rate of crude going forward, regardless of what happens in the Middle East.
I'm trying to work that out too. For how long will the Saudis withhold barrels? Are they just going to sit there and let this crude move, carry on? For how long will the White House just sit there and do nothing? We know they don't want to refill the SPR. Are they willing at some point to drain it again? That's what I'm focused on going into the summer.
I want to ask Ellen Wald about this. How much capacity do they have to drain this and what that means for gasoline prices, because it has to do with refining as well. But also, Saudi Arabia, do they have some sort of a bone to pick here in terms of who they want to win the election and how they want to sort of put their thumb on the scale?
They're going to do their best to talk about this has to do with supply and demand constraints, nothing to do with politics. But if we go into the summer and we start seeing $4 a gallon of gasoline, we start potentially seeing $5 a gallon gasoline, you better believe the SPR potential tap is on deck, as well as a lot of pressure on Riyadh.
Brent crude right now, $90 and about 30 cents. WTI, $86. Let's get into the market action for you, starting with equities on the S&P 500. Equity futures right now just slightly softer. We're down about 0.1%, coming off the back of the biggest weekly loss since the start of the year. Yields climbing through last week into this morning. Yields higher this morning, Lisa, by 4 basis points, 440.60 on a 10-year.
I know that we always say this, but this is a massive week. I have to say, we've got the trifecta. On one hand, you have key U.S. inflation data with CPI on Wednesday and PPI on Thursday. We also get Fed commentary as well as an ECB rate decision. How much do we get them kicking off a potential rate cutting cycle? Thursday, we'll get some guidance. Is June still very much a go? And then earnings season kicks off. And on Friday, this to me is possibly the most interesting kind of bifurcation. What matters more, central banks or the earnings? Citigroup, JP Morgan, Wells Fargo, all kicking off. We're also getting Delta earnings on Tuesday, but I'll put that aside. How much is that going to be in the front driving seat versus, say, some of the inflation rhetoric and questions around Fed policy?
I don't know, but I can say this. I think we're all done with the Fed speak, aren't we? I think we are. We're done with the Fed speak and we can move on to Q1 earnings.
You really want to do that?
Yes.
You want to say that? Because somebody's going to come out and they're going to say something and all we're going to be talking about is that Fed speak.
What would it take? Governor Bowman's already come out and entertained the idea of perhaps talking about interest rate hikes later this year. What would you need to see to make that conversation more interesting?
That the neutral rate going forward is something closer to 4%. That kind of idea would torpedo markets. To me, one of the biggest untalked about issues is the fact that in 2025 and 2026, rate cutting expectations are actually greater than where they were at the beginning of the year. This is a long-term kind of structural play where people have complete faith in the Fed. What if the Fed doesn't have complete faith in themselves?
If you want more of that, you're going to get tons of Fed speak this week, and maybe that is what you want. Coming up this hour, Jeff Yu of BNY Mellon, as investors looking ahead to a busy week of data. Former White House fellow Elliot Ackerman as tensions escalate between Israel and Iran, and Bloomberg's undercurrent as Treasury Secretary Janet Yellen wraps up meetings in China. We begin with our top story. Investors looking ahead to the latest CPI print and the big banks kicking off earnings season. Jeff Yu of BNY Mellon writing this. While flows may remain heavily focused on the US, cross-asset price action last week suggests that not all will be rosy for risk appetite. Markets are vulnerable to surprise outcomes in policy and data amid positioning volatility and shifting correlations. Jeff, I'm pleased to say, joins us now. Jeff, let's start there in the bond market. How much of a challenge are these yields to this equity market?
Well, yield levels are a challenge, but also the pace of the moves will be an even greater challenge. You know, with a bit of my FX hat on, sometimes it's not about levels, it's about the speed at which you get to certain levels. If I compare the move from 4 to 4.5 right now in the 10-year, somewhat slower compared to the rounds of bear steepening that we had last year. But if this accelerates, that tightens financial conditions much more quickly than markets are ready for, then you get the volatility. As you mentioned yourselves, if earnings do not meet lofty expectations, that generates volatility as well. And finally, we've got the geopolitics. So that's why I said it's not all rosy out there.
Well, Jeff, let's start with the data and we'll run with payrolls from Friday. You've got to learn something from the data and how the market responds to it. Are we learning that good news is actually good news based on what happened on Friday?
Well, we actually had this discussion internally today, and let's just say no longer are we saying absolutely slam dunk, good news is going to be good news. At what point do we trigger that round of bear steepening such that good news starts to shift into bad news? So especially given all of the investment that's going into the US right now, not just asset allocation, but looking at the headlines from this morning and last week and the last 7 days, I count $50 billion in investment via direct or subsidies by Asian chip manufacturers into the US. And that can be inflationary, given the value-added component to the US economy. So how do you offset that? And this should be good news on the corporate front. But if that translates into higher yields and tighter financial conditions, it might not be good news either.
Jeff, just to put some numbers on this, I'm looking at real yields, inflation-adjusted yields in the U.S., since that typically is what triggers a lot of concern in the risk environment. This is not inflation-driven. We're now north of 2%, once again, in terms of real yields in the 10-year. That is the highest level going back to the end of last year. Why do you think this is happening? Is this basically a belief that the Fed is going to hold rates higher for a much longer period of time? Or is this just idiosyncratic selling from a particular cohort that don't believe that the 10-year is any longer the ballast, the haven type of asset?
I would say it's a combination of factors, but if you look at the productivity element, if you are actually anticipating stronger productivity gains in the US, then in real terms, real wages should be higher. And then consequentially, real interest rates should be able to reflect that, because at the end of the day, what deflator do you use? Do you use a normal PC one or a CPI one, or do you actually use earnings? And what level of real yields do you want to reflect the underlying conditions in the US? I think people are looking at productivity gains or the investment going to the US, and that's benefiting earnings accordingly. But again, how long can this be maintained? Because one sector may be doing well and continue to generate productivity gains, but that's going to come at the expense of other sectors as well. So I think it's going to be a delicate balancing act, but markets are not questioning the Fed, at least not yet.
When you say is good news, and that was a question that John asked, I wonder for what, right? Is good news becoming bad news maybe for bonds, but still pretty good news for stocks that might also face off with a pretty positive Q1 earnings season? Is that basically your view?
Well, I think, right now you need to be in the US market. So it perhaps is good news for US stocks because there are no alternatives elsewhere. Let's look at the guidance from the ECB this week. I think this week is actually a live meeting as far as the ECB is concerned, though probably June is more likely when they're going to cut first. There's no good news coming out of Asia, according to our data. All clients, so every single APAC currency almost is short right now amongst our client base. So you're almost forced into US markets, be it bonds or cash or equities. So in that sense, as long as the US keeps on surprising or even meeting expectations, then it is good news. But then the bar just gets set higher and higher. And then the moment that you see forward expectations on the earnings side start to disappoint, that's when the correlations begin to crack. So I think that's what we need to look out for in Q2.
Hey, Jeff, back up. I heard about 1% of what you just said. And then I was thinking about just that and ignored the other 99. Live meeting Thursday, ECB. Jeff, what does that mean?
Well, going back to my parity call in terms of euro-dollar, which is, in fairness, not super far from where we are right now, you will get voices calling now is the time to act. If I look at wage growth in Eurozone, if I look at where the PMIs are, we need to distinguish in Europe at least. So less bad from a very, very bad environment. It doesn't mean things are getting better, right? And if we actually do get energy prices going, the supply constraints as well, that I think is going to be negative, for European growth as a whole. But the hawks on the governing council could then again argue, oh, inflation expectations are going up again. We're worried about a price spiral. Let's keep rates where we are. So that totally different reading of where the Eurozone economy is right now between the dovish camps and the hawkish camps, I think that's going to come out more into the open. So the decision itself is probably going to be on hold, like all the other 7 central banks due to decide this week. But I think you are going to see much more two-way dialogue. And at the very least, there will be calls, I expect, for cuts as well.
Jeff,
so
I just
in
want to
that
be
sense,
super
it should
clear.
be a live meeting.
Are you sticking with that parity call on euro-dollar this year?
Absolutely.
How much pushback are you getting from clients regarding that?
So I would say there's sympathy with the view right now, and the broader client consensus is euro lower. Perhaps parity at this point is one of the more aggressive targets right now if you look at options pricing. So sympathy with the direction, pushback perhaps against the target.
Interesting. Jeff, wonderful to catch up with this fantastic call, that, just to have a discussion on euro-dollar parity call this year. Jeff Yu, FBNY Mellon. Jeff, thank you. Just getting some breaking headlines. Jamie Dimon's 2023 letter to shareholders. Just dropping, Bramo. What do you see?
Well, first of all, he talks about his macro call, which is what everybody finds interesting from a lot of these letters. These markets seem to be pricing in a 70 to 80% chance of a soft landing. I believe the odds are a lot lower than that. So speaking to that, of course, we'll see earnings when he probably produces another record gain. So we'll get that sense. He does talk about artificial intelligence and about how over time it could be potentially revolutionary, akin to the internet, that has the potential to augment virtually every job. And then he talks just generally about the government deficit and printing a lot of money, and how basically what we have seen is an economy fueled by government deficit spending and past stimulus. So, okay, Treasury Secretary Jamie Dimon, let's hear what you have to say.
Inflation may be stickier, rates might be higher than expected. I think you've touched on the important topic here. Is this a man in a risk management seat? Is this a man making a call on the economy? Is this a man who's sort of leaning towards Treasury and Washington, D.C. over the next 5 years? What is it? This
is the House of Dimon, led by Dimon, with Dimon in the front seat, trying to give off his larger-than-life kind of message, which he does pretty much every year. You can speculate on his tax trade or whatever else you want to do, but the bottom line is some of what he's talking about, he has talked about before, and others are talking about the similar types.
There's a lot of questions swirling in Washington after he made those comments about former President Trump in Davos. And then recently he was at the White House having lunch with VP Kamala Harris, and someone in the White House quipped to me, the days of Davos are long forgotten. They've moved past it. One line that stands out to this letter, the staggering inability of the government to draft and pass a proper budget causes deep and unnecessary damage to our growth. We've been hearing a lot about this on this program and what this means for the Treasury market.
And yet here we are talking about the economy that remains resilient. Even with that, dysfunction down in Washington, best economy in the world right now relative to Europe and everything that's taking place there?
Michael Zizas put out a piece for Morgan Stanley talking about how the deficit is going to grow with either Republicans or Democrats, probably more under Republicans than Democrats, but it won't matter because people can still chug along. But this is the bottom line, right? How long before it matters? And right now, people can scream about it all they want. People can care about the auctions. Doesn't mean anybody else is going to care about them.
The latest from JP Morgan's Jamie Dimon. You'll hear more from him on Friday when we get earnings from JP. Equities right now, equity futures look like this. We're down by 0.1% on the S&P 500 with some stories elsewhere. Your Bloomberg Brief. Back with us, here's Danny Berger. Hey, Danny.
Hey, John. Chipmaker TSMC is going to be receiving $6.6 billion in grants. They'll also get as much as $5 billion in loans from the U.S. to build factories in Arizona. It's a prelim agreement, and the company will build a new factory in Phoenix, adding to the 2 facilities it already has in the state. Production is expected to begin in 2025 and 28. The newest factory factory will be building next-gen 2-nanometer chips. Those are essential to building emerging tech, including AI and military applications, too. David Ellison is closing in on Paramount. The movie producer and tech heir has a month to seal a definitive agreement, but first it needs to sell Paramount's board on the merger with his production company, Skydance Media. Ellison would serve as the CEO of the combined company. That's according to people familiar who asked not to be identified due to the sensitive nature of those negotiations. His father, Larry, the co-founder of Oracle, is one of several names being floated for the role of chair. And for a few fleeting moments today, Americans will turn their gaze towards the sun as the path of a total eclipse tracks across cities from towns from Texas to Maine. The entire event will last for several hours, but the main spectacle where the day turns to night as the moon obscures the sun is expected to last for only about 4 minutes. So get outside, get your glasses. The event has been backed a tourist boom with areas along the path fully booked. Buffalo called it their Taylor Swift, their Super Bowl. Meanwhile, the U.S. will lose more than 30 gigawatts of solar energy as sunlight is blocked during prime generating hours. That's roughly the output of 30 nuclear reactors. And that's your Bloomberg Brief. John.
Amazing. Danny, thank you. Guess who came in this morning prepared with glasses? Guess who? AMH.
And I bought one
AMH.
for each of you.
Thank you. I have.
Are we doing
I'm
a
very
group?
excited.
Are we doing a group session? Is that what we're doing?
Cool.
Yeah, you can't see
Are they
anything
though?
through them.
Are they?
You're not going to watch?
No.
Well,
It's nap time, isn't it? 2 p.m., 3 p.m., something like that.
Can I just PSA? Don't look at the sun if you don't have the glasses. I have lectured my kids time and time again.
Is this the lecture for the kids this morning?
If you're watching, kids, please, I'm telling you, you will get
Do you
one.
remember former President Donald Trump staring at the sun?
Yes, I do remember that.
Yeah.
Don't do that, please.
Don't do that. Up next on this program, Israel preparing for Rafah.
We have been increasingly frustrated, and again, that was a core message that the president delivered to Prime Minister Netanyahu in their phone call this past week, that if they've got to do more, they've got to make changes.
That conversation up next, live from New York City this morning. Good morning. Just for the record, AMH thought she bought the solar eclipse glasses. They're actually the 3D glasses for the movies.
No, they're not.
Be very careful about this.
Okay. About who, Annmarie?
Yeah, about people like AMH selling this stuff on the streets of Manhattan.
It's free.
You know, 3D
Really?
glasses
They're
for
real.
the movies. Equities right now in the S&P 500, they're not. Negative 0.1%. Yields are higher by 3 or 4 basis points. Your 10-year 4.4399. Under surveillance this morning, Israel preparing for Rafah.
We have been increasingly frustrated, and again, that was a core message that the president delivered to Prime Minister Netanyahu in their phone call this past week, that if they've got to do more, they've got to make changes. Now, the Prime Minister assured the president that he would do that. We've seen some announcements in those early hours. That's welcome. We got to see more. We've got to see it over time.
It's the latest this morning. Israel pulling some troops out of southern Gaza, preparing for an operation in Rafah despite growing pressure from Western allies. Prime Minister Benjamin Netanyahu saying Israel is one step closer to victory, but reiterating there will be no ceasefire until the hostages are released. Elliot Ackerman, the former White House fellow, joins us now for more. Elliot, difficult question, I guess, but are you clear on US-Israel policy after the events of the last week?
No, I'm certainly not 100% clear, and I think the U.S. really is running the risk of sounding pretty hypocritical in its warnings to Israel about civilian casualties, given the number of civilian casualties the U.S. has inflicted over the past decade. But even if you look all the way back to the history of the United States and what we've been willing to do in terms of attacking civilian targets in wars that have been really existential to our survival.
When you look at potentially not being clear, we heard from Admiral Kirby there, and he says that what Israel is doing in Gaza with some troops coming out, he says this has to do in direct consequences of their conversations. Yet you hear from Democratic Senator Coons talking about the fact that he actually thinks this is tactical. Israel wants to potentially have a reset or potentially maybe move some troops to the north if they're going to have an issue with Lebanese Hezbollah. What do you make of this specific move Israel made over the weekend?
Well, you know, what we're seeing is Israel's 98th Division is moving out of Khan Yunis in the south. And, you know, the question is, you know, why is it moving out? and the Israelis have announced an operation in Rafah. For some time they've been telegraphing that move. So it would seem that this is tactical. That you have to withdraw troops to send them into combat elsewhere. And the 98th Division has been in combat for about 4 months now, so they probably do need to rest and refit. All that being said, though, tactical troop movements can be used to serve as strategic cover if at a certain point the Israelis decide that they're not going to go into Rafah, or that they're going to make that type of a concession. So I think we just sort of have to wait and see what this means.
If Israel's going into Rafah, the United States is talking about potential consequences. At the same time, we had hostage negotiations over the weekend. Are they just now for show, for public optics?
I think it's not inconsistent to have two parallel tracks of action going on at the same time. We can have hostage negotiations simultaneously as Israel is reposturing itself for an offensive that may or may not take place based off of the outcome of those negotiations around hostages or even around a ceasefire. So I think, right now we're at a point of really, a lot of uncertainty in the war and a lot of multidimensional aspects of the war, from negotiations to internation negotiations around a ceasefire to tactical operations, the potential of a new offensive opening up.
What message do you take, Elliot, from the fact that we have not seen an Iranian retaliation yet from the killing of their senior military officials?
Well, these things take time. I think we will see that retaliation because just like the United States or any other nation, the Iranians have a domestic constituency, and they have to retaliate in order to show strength to that constituency. But what shape that retaliation takes and how effective it is yet to be seen. So I think the Iranians will certainly at some point claim that they have retaliated.
I guess that the way that the market is treating this is that, especially with the withdrawal of troops by Israel, the fact that we haven't seen yet a retaliation from Iran, that there's a softening in the proposition of a potential escalation to a broader regional conflict. Do you think that that is an accurate way of reading the events over the weekend?
I think it potentially is. Whenever you're in a conflict like this, there are always these off ramps, and both sides can choose whether or not they take the off ramp. So at this moment, Iranian retaliation, it could be something very, very minor, and they claim that they've retaliated, and that creates an off ramp to begin negotiating. I would point out that if the Iranian retaliation is extreme, that then makes it very difficult for Israel to come to the negotiation table. So we're just going to have to watch and see how this plays out.
That conversation is certainly the epicenter of the crude market this morning. $90 on Brent. We're down about 0.8%. Elliot, always wonderful to catch up with you. Elliot Ackerman there, the former White House fellow and co-author of 2054, a novel of the next world war. Lisa, you're right to point that out. Iranian confrontation with Israel, how that plays out, if at all, is going to be key to where we go in crude this week.
The fact that we saw the increase in crude prices, and a lot of people are pointing to the potential for Iranian escalation, that we heard about jammed GPS signals in Israel as people really hunkered down, Iran really talking in hard words about targeting the U.S. as well. The fact that nothing has happened and that troops are being removed from certain areas of Gaza seems to have taken some of the temperature down. Whether that lasts, though, really remains to be seen. Again, as Elliot was saying, you can't game this out, which is the reason why it's difficult for people who are trying to.
Iran will go to their Security Council and weigh the options of what they want to do. Is this going to be something potentially in the Red Sea and the Indian Ocean? Is this going to be something potentially in Israel? Or are they going to go to other foreign countries? We've seen this before. Reports, Georgia, India, Thailand, in the past that Iran has tried to use to target Israeli officials. And I think what we need to wait and see, like the GPS that Israel was talking about that was getting spun out of control because they wanted to try to make sure that no drones could attack, we need to look to what the U.S. and Israel say, what embassies to avoid and what places to avoid, and potentially that's what they're concerned about.
For now, at least, some of the heat coming out of this commodity market. WTI is down about 0.8%. Crude this morning, 86 on WTI. Brent crude, $90 and about 40 cents. Coming up on this programme, Bloomberg's Enda Karen as Treasury Secretary Janet Yellen wraps up her latest trip to China. If you are just joining us, equities are doing OK, down about 0.1% on the S&P 500. But starting the week with new highs for the year on 10-year, 2-year and 30-year bond yields. Yields are higher by about 4 basis points. From New York, this is Bloomberg. Live from New York City, welcome to the program. Equity futures on the S&P 500, negative here by 0.06%, totally unchanged on the Nasdaq 100. Weaker losses last week, biggest weekly loss since the start of the year. Still, only the 5th week of losses since the end of October. The underperformance last week, interestingly, and we can talk about this through this morning, small caps, worst week since the start of the year as well. Really underperformed, Lisa.
Completely tied to the bond market as you saw yields go higher with the expectation that the Fed would not have the justification to cut. I would just want to point this out, though, about how rare it has been to see any kind of decline whatsoever this year. That the S&P hasn't had a down 2% day since February of 2023. This is the 12th longest streak since 1928. That, according to Citigroup's Stuart Kaiser.
That's amazing. That's quite a stat. It's been that good. That's how strong this rally has been since the end of October. The reasons for that rally have shifted quite a bit, and we could talk about that too. In the bond market, yields look like this: 2-year, 10-year, 30-year. Last week, we had sub 420 to start the week on a 10-year, and we finished it north of 440. And then this morning, we had some weight to that, up by 3 or 4 basis points. A 10-year yield of 443.59, yields up by a couple of basis points and getting closer to 480 on a 2-year, Lisa, 477.39.
So this question also came from Stuart Kaiser. This week on Wednesday we get CPI, and a lot of people view that as maybe the moment that we find out whether the bump idea is just the same as transitory was a couple of years ago, to quote Priya Misra. But is an inline report a beat? Is that how the market treats it? Is it basically the threshold of saying at least inflation did not surprise to the upside? Because that seems to be the big fear that's been baked into the rates market over the past couple of sessions.
Can I say yes and just say yes a few times? Inline has got to be seen as a beat. At the moment, overwhelmingly on the street, the consensus view is non-inflationary growth. That's the story. Most people look at payrolls from Friday, really, really strong payrolls growth, and then you look at everything else, wage growth comes in line. People are taking a little bit of confidence from that. So if you get inflation data coming in line as well, they can just embrace that supply side story, I guess, even more.
Is it a good enough reason to buy the long end? The long end has been a mystery to me, and that sort of goes to the Jamie Dimon existential angst of the deficit and this question about interest rates longer term. That has been the most volatile area, and one that is most of a mystery to me, because what is the reaction function if you do think that the Fed is going to hold rates higher for longer? Is that positive for the long end? Or if you get the sense that they're going to do these prophylactic cuts, does that mean that you could see that kind of priced into that longer-term benchmark rate?
Informing some of this will be what happens here if you switch at the board and just roll forward to Brent crude and WTI. We've had a big move higher in crude, a move of something like 4.5% last week to the highs that we haven't seen since October on both Brent and WTI. We're just pulling back a touch there, but what happens here is going to be critical to that conversation around inflation going forward and the Fed's tolerance of it. And that's how I think things develop at the long end off the back of that.
And it's not just commodities. I mean, it's not just crude. It's also broader commodities, whether it's gold or chocolate or a lot of other things. So this is sort of the reason why they have to take it into effect a little bit more, especially with the driving season and especially given the fact that it's going to be a political hot potato and all of that jazz.
So you drain the SPR around September time?
I don't know if they have the ability to.
August?
I don't know if they have the ability to. I mean, honestly, they've gotten to such a low level. I've heard mixed things. I know you know this better than I do, but honestly, I've heard so many people say to me, we're kind of bumping up against the edge here.
We are definitely well below the peak we had under the Obama administration, but yes, they can drain it. They can drain it for a bit. It's not going to be the same levels we saw previously under the Biden administration, but they can make a few. They can make a few moments, and a lot of that would potentially be jawboning as well.
Brent crude back to about 90 so far this morning. Under surveillance this morning, a busy week ahead. US inflation data on Wednesday, the ECB with a decision on Thursday, and the big banks kick off earnings season with JP Morgan, Wells Fargo and Citi set to report on Friday. So let's set the scene for you. Let's do Apollo versus Morgan Stanley. Ellen Zentner and Morgan Stanley, the data point to a non-inflationary expansion of the labour market and do not alter the Fed's course to a June cut. That's Ellen Zentner, Morgan Stanley. Here's Torsten Slock over at Apollo. The economy is re-accelerating. We're sticking to our view that the Fed will not cut interest rates this year. That's how divided things are at the moment.
Right now, I keep saying, what's going to be more important, the Fed and the macro or earnings? And what it all points to me, is that there's bigger risk in bonds and there's less risk in stocks, especially if the earnings come in better than expected. That all flips on its head if suddenly you start to get this weakness. But it just shows that there is no consensus whatsoever on Wall Street about how to read some of this data and what it means for the trajectory going forward.
And a lot of that no consensus on Wall Street and how to read the data is because it almost is a different economy in the sense. Jay Powell talked about this. It's a bigger economy, not a tighter one. How much is immigration playing into, say, the jobs market? And is that helping keep a lid on wage growth? thus inflation. And everyone is now going to be looking towards CPI because now that we have jobs out of the way, this is potentially the next data point, could really point to what the Fed is going to do, say June or July.
As Lisa mentioned, CPI on Wednesday, then bank earnings on Friday. Getting a flavour, a preview of what Jamie Dimon thinks about the world in his annual letter to shareholders. Dimon devoting a large portion of the letter to AI, saying it may be the biggest issue the company is dealing with. Dimon also issuing a warning on the economy, writing, quote, "These markets seem to be pricing in at a 70% to 80% chance of a soft landing. I believe the odds are a lot lower than that."
So how is he handling his business, right? We're going to find out about that, hopefully, on Friday. When he talks about artificial intelligence, aside from the macro calls and sort of, the Treasury Secretary light that's coming to the fore, there is this issue of how much AI is going to transform just his staffing levels, where they're hiring, where they're cutting back, who they're putting their money into. Those are some of the things I'd like to hear from him. I mean, these kinds of big proclamations, he's talked before about 7% 10-year rates. At this point, it actually looks less far-fetched than maybe a year ago. But, these are some of the things that he's come out with and with some of these warnings in the past.
Doing more with less. Let's roll back 2 weeks. Brian Moynihan, Bank of America. I thought the conversation with him about AI was quite revealing. Each additional dollar of revenue at these banks every single year from here is going to become less and less labour intensive. So it's not that you may see, I don't know, 10, 20,000, 30, 40, 50,000 people being laid off. What you'll see is these companies will get bigger, and they'll do it with fewer people relative to that expansion in revenue. That's going to be of some concern, I think, to younger age groups coming out of college looking for jobs, because the grad schemes at these banks, which a lot of people are dependent on coming out of high-flying colleges, worked very hard at their degrees, sacrificed a lot of time, this is the career they want. The hiring relative to the size of the business is just not going to be the same. That's going to be a big change we could see.
And the grunt work that typically people come in and they have to be sort of the assistant to a banker or someone else, and you sort of learn through all that grunt work, is going to be done by a computer, right? So at what point does that eliminate the opportunities to learn? It's a great point. The silver lining might be, as Brian Moynihan said, fewer people, but they're all paid a lot more. So maybe, the upside...
If you get the golden ticket, right.
Exactly,
yeah.
right. It's just sort of getting it as
if you get the golden ticket to be that one person that makes it on the desk. But I think it's interesting that he almost led the letter with it. It feels like this is what his bank is grappling with at the moment as one of the top issues and how it transformed the business.
I've got to say I'm far more interested in the actual numbers on Friday than I am sort of the stuff about AI in the future in the next...
I just want to hear
5, 10 years. That's what you want, broad proclamations.
That's all I want.
I'm sure that's what they want you focused on as well.
I'm very focused on it.
Yeah. Treasury Secretary Janet Yellen wrapping up her latest visit to China. Yellen pushing leaders on the country's output, saying excess production and subsidies will lead to significant risk to workers and businesses in the United States and the rest of the world. I'm pleased to say that weighing in on this with us is Enda Curran of Bloomberg. Enda, it's almost like the self-discovery tour of Janet Yellen, a change of thought over the last 10, 20 years for her. How is this pertinent to policy shifts from the US administration anytime soon?
Well, look, Ms Yellen certainly has travelled a journey on the China relations story. During her trip, it seemed to be full of both criticism and there was plenty of cordiality as well. And on the critical side, as you mentioned, Ms Yellen rolled out some of the familiar complaints that we now know about it, which is basically China's manufacturing too much stuff and exporting into the rest of the world at very cheap prices. Interestingly, she said that's not just a threat to US workers, but she mentioned global workers as well. So maybe a hint there of trying to build up a bit of a global alliance as she tries to beat the drum on the overcapacity story. And then Ms Yellen also raised complaints about China's support for Russia, of course, and she made the point that China needs to drum up its own domestic demand and buy more of their own stuff than send it overseas. But the cordial side, the old Miss Yellen, the sort of, the kind of Miss Yellen that China would like in the past was also there. There was a cruise on the Pearl River Delta, and there was an exchange of gifts between Miss Yellen and Chinese officials. So it was on the one hand delivering the hawkish message that we've become used to, and on the other hand playing the old Yellen card that we know well also.
She's talking about the cost of steel a decade ago and that overcapacity we saw from China. Many are equating that to what we're seeing potentially now in the EV space. And she says the president and I will not accept this. They have gone out of their way to showcase that tariffs are set to come. Enda, do we have any timeline on when we would see these tariffs?
I don't think we have an explicit timeline on it yet, Annmarie, but you're absolutely right. Ms Yellen was certainly delivering a message to China that they are not happy with their economic growth strategy, and all the implications are that the US will respond. And the Xinhua response, by the way, from Beijing, even though there was somewhat of a cordial tone around the meetings, the Xinhua hit back and said that really Ms. Yellen has come to deliver what they consider to be a preemptive warning that more tariffs or some kind of export controls are coming down the line. So certainly China is bracing for it. But China also seems to be playing nice during this visit. I mean, typically, given the amount of criticism that Ms. Yellen levelled, you would have expected a more robust rhetorical response. That doesn't seem to have been there in the state media reports that we've carried so far. So maybe there's a feeling as well that China expects something coming down the pipes, but they're also willing to play the waiting game a little bit because they know what's coming up in November. There's going to be the election, and this may well be, of course, Ms. Yellen's final trip to China as Treasury Secretary.
And there was a lot there to unpack. I do wonder if there's the economic appetite to withstand some of these tariffs without retaliation on the part of China. Is that what you're saying, that basically they're willing to wait, just grit their teeth and bear it if there are additional tariffs?
So there's one interpretation out there that China's economy, as we know, is not as strong as it could be. It continues to be hobbled by the real estate sector, in particular. Manufacturers going strong and exports, but real estate is hitting it hard. At the same time, that the US economy continues to beat all expectations. So there is a view that China is willing to lie low a little bit during this wave of criticism because it wants to put out the welcome mat for FDI. It wants to get portfolio flows coming back into China. Remember that meeting Xi Jinping had with the US CEOs only a few weeks ago? So that they're clearly trying to dial down their rhetoric. But then on the tariffs in particular, again, China knows full well there is the election coming up in November. There could be a potential change of administration that could lead to even a sharper change of approach on China policy. So I think a lot of analysts watching this do feel there's a bit of time out in this. Both sides are trying to stabilise relations, but China is more than happy just to run down the clock and wait and see what comes out of that November vote.
And thank you, sir. Appreciate the update. Andy Curran there of Bloomberg down in Washington, D.C. I think a lot of people on Wall Street have sort of got August, September circled as the next move potentially from this administration. Why do it now when you can wait until right before the campaign starts to really pick up going into November?
Yeah, and a theme I heard was potentially that they don't want to turn this into infrastructure week. Every week becomes tariff week when reporters are asking them, is it done, is it done? But obviously, if you have an election in November, you are going to hold your biggest arsenal till September, October, maybe even August. So if the rhetoric on China is going to ramp up, potentially that's when we'll see those tariffs, when they would matter for the domestic audience.
So what's in the arsenal right now? Drain the SPR around August if you need to? Go forward with big tariffs on Chinese EVs?
Tariffs on Chinese EVs. The Commerce Department is also looking into connective vehicles. This has to do with Chinese EVs as well, potentially more export controls on some of that technology, the tariffs, and, yeah, of course, the SPR. To Lisa's point, it is not at the level that it was when Biden came into office. But they could still drain a few millions, and potentially that will help the market. They're going to need to if we're seeing $4 or $5 gallon of gasoline. Every American consumer, even if you walk, you pass a gas station. That is a reminder of higher costs. And inflation obviously has dogged this administration.
And it talked about China waiting it out. Waiting it out for what? Waiting it out for who?
Well, that was exactly what I was thinking. At this point, given the fact that this is sort of a campaign tool, it gives you a sense of what the temperature is and sort of the general population and what you can expect with either administration.
More on this a little bit later. Equity futures right now on the S&P, negative about 0.1%. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs says that European stocks are likely to outperform the U.S. over the next year. Sharon Bell and team cited factors like global manufacturing and a global PMI upswing. And the ECB cutting rates, they say, in June. Financial, energy, and consumer discretionary will be the best performers, they wrote. Shares of Boeing and Southwest Airlines lower in the pre-market trade. The FAA announced that it's investigating yet another in-flight incident. This time, it was an engine cover that fell off. It struck the wing of a Boeing 737-800 during takeoff from the Denver airport on Sunday. Then the Houston-bound flight returned safely, and the plane was just towed to the gate. Boeing is still under regulatory scrutiny after a door panel blowout on an Alaska Air flight earlier this year. The South Carolina Gamecocks are national champions. They defeated the Iowa Hawkeyes 87-75 in the women's NCAA title game. This is now South Carolina's third national title in just 7 seasons. It's also the 10th D1 team in history to complete an undefeated season. But the real highlight, it was Iowa's Caitlin Clark. She ended her career with 3,951 points. Now she leaves as the all-time leading scorer in both men's and women's college basketball. Really remarkable, and that is your Bloomberg Brief, John.
Hey, Danny, thank you. What a phenomenal athlete. What she's done for sports, for women's sports, has been absolutely incredible over the last few weeks.
People have watched her over a lot of male athletes. She's been the draw. I mean, honestly, all the jokes about going to a bar to watch women's NBA and sort of this question of whether college basketball would get anything, all went out the window.
Shaquille O'Neal, I'm not watching the boys. His words, suck. I'm only following the girls. That's where some real incredible athletes are. This was him the other day on a podcast.
I can't name one. I can't name a single male athlete from college basketball. I'm just your average observer, of course. What do I know? But that's been the story over the last month.
She's the star. So here, where does she go next? And what does she do
Big
for the
time.
sport?
That comes with ratings. That should come with money as well. And it's well deserved. Up next on this program, inflation, testing the Fed's patience.
What we're hearing from the Fed is patience on inflation. But, they can only be patient for that long. They're trying to say this is a bump in the road. Maybe bump is the new transitory.
Love that line from Priya. That conversation coming up next. Equities on the S&P 500 negative here by 0.05%, just a little bit softer to start the week. Yields a bit higher, up 4 basis points, 4.44 on a US 10-year. Earlier in the session, new highs for the year on a 2-year, 10-year and a 30-year. Crude pulling back just a touch. We're negative here by 0.7%, $86 and about 32 cents. Under surveillance this morning, inflation, testing the Fed's patience.
What we're hearing from the Fed is patience on inflation. But, they can only be patient for that long. They're trying to say this is a bump in the road. Maybe bump is the new transitory. But what they're telling us is, this is not suggesting that inflation's not moderating. But how many months can they be patient? If service disinflation doesn't continue to slow down, I think that's where this Fed patient narrative is going to run thin.
Here's the latest. Investors looking ahead to March CPI data on Wednesday for clues about the Fed's path forward. FS Investments chief economist Lara Rain writing this. Markets are on edge as the upside surprises for inflation keep coming. Under the hood, the mix of inflation remains a problem. Services prices are just too high. Does the Fed need to cut rates? No, there's an exclamation mark, and she's going to scream that for us in a moment. There is no urgency for a rate cut. My forecast is for surgical rate cuts, starting possibly Q3 or Q4. No, Lara Rain joins us right now for more. Lara, you can do that in a moment. I want to start with Priya Misra of JP Morgan Asset Management, who asked the question, maybe a bump in the road is the new transitory. Does that resonate with you?
I think that's well phrased because it's starting to feel a little bit like deja vu. Month by month, we're pointing at just one factor or one or two small one-off sub-indices that are giving an upside surprise and giving us a 0.3% monthly gain instead of 0.2. Well, if you get 12 months of those, it adds up to 3.2% inflation, not 2% inflation. And that whack-a-mole sense is come back in just like it did. It's not a massive reacceleration story, but it certainly is not pushing inflation back into that convenient 2% lane that we occupied for so long before the pandemic.
Laura, let's dig a little bit deeper into that as well. The consensus, I think, on Wall Street at the moment is that you can surprise, or rather you can embrace the supply side story, that growth is non-inflationary at the moment. I think Chairman Powell shares that too. Laura, what's the biggest challenge to that view right now?
I think the challenge is it's not just CPI. We're starting to see, it's been a month and a half now of inflation upside surprises from producer prices, from commodity prices moving higher. The ISM manufacturing price sub-index hit the highest in 2.5 years. So it's not just consumer prices. It's really sort of seeping and bubbling up from a lot of different places. And listen, services prices are stickier. I think that's the issue. And again, it's not just rent. So, you're seeing a nuanced story around inflation. I think unlike the growth side of the economy, everyone, there's more consensus around the fact that we're in good shape. On the inflation, there's still a wide range of consensus. And what is surprising is Powell, interest in dismissing the latest data. Again, there's no urgency to cut rates. So the fact that he still seems so intent on that path, I think, is causing a bunch of us to wonder what the conviction behind the rate cut is at this juncture.
Maybe this is a reason why, Laura, you said also not higher for longer, but a renormalization of interest rates to the 1990s and 2000s. The 10-year retests 5% at some time this year. What do you think is the trigger for that, given that everything we've seen so far, we're still quite a bit of ways from that?
We're still a ways from it, Lisa, but I think that we're on that trajectory. It's the higher inflation numbers. It's this very strong growth numbers. It's the productivity numbers that look fairly solid. And then I think there's this supply side issue in treasuries that's just not going to go away no matter what you change with the mix of funding. At the end of the day, if we're not going to have a recession, the yield curve should normalize, and it's still deeply inverted. I see that as more of a twist, some surgical rate cuts later in the year, but long-term rates drifting up. And if we have a healthy economy with 3% inflation, there's no reason why long-term interest rates shouldn't align with nominal GDP. That puts you in the 5% range at least. I don't think we should be as worried about that as we were with the rapid rise in rates that we saw in 2022 and 23.
I'm old enough to remember the last time we got 5% 10-year yields, and people were talking about something breaking and bank failures and commercial real estate falling out of bed. Are we basically taking that off the table now and saying this is an economy that can handle that with no problem?
I am, because I think that this time last year when we touched 5%, it was the speed at which interest rates moved up so fast. I make the comparison, if somebody from warm weather moves to New York in the middle of winter, there's going to be a very unpleasant shock and you're going to kind of freeze up. But the second winter, the third winter, you kind of get used to it and you're out and about doing everything that you would be doing normally. I think that's the right comparison here. The longer that we're at these interest rates, the more that we'll price in this into the cost of refinancing, the cost of buying a home, and the cost of M&A activity. I think, all of that will normalize. It was just the shock of the speed of the move. We're moving there gradually now. I don't think it's going to be as much of a problem for markets to digest.
If the economy is fine and well and good, and these surgical rate cuts, you have about 2 or 3 priced in. Are you actually prepared to pare them back to potentially 1 or none?
I am. And I've been sort of, on the fence about saying that I don't think 2 or 3 rate cuts are needed. I just think it's what the Fed seems to have conviction they will deliver. I think that look at markets today, financial conditions, credit conditions. I don't think that we need these rate cuts. At the end of the day, you're looking at a world with higher interest rates offering a rich suite of alternative investments away from traditional equities. I think markets have digested these higher interest rates just fine.
Laura, can I just say that it's winter 8 or 9, and no, I have not adapted. Laura Rain, thank you, of FS Investments. Maybe I'm like office vacancies in that analogy. Is that what I am?
Okay, so you haven't adapted. Public service announcement. Just say this, get the right equipment. You don't have the right equipment. That's all I can say.
What's wrong with, hang on a minute, you're so aggressive about this.
He's got the Montclair.
Pause, what's wrong with what's the equipment? Let's just start there. What do you mean by the equipment?
You need to commit to the cold weather and then get the sufficient, whether it's a warm jacket, whether it's warm gloves, whether it's a hat, commit to going out there and experiencing the cold. But it's about embracing the experience of it all.
Like ugly boots? Is that what you're talking about?
I've seen it. He's got all Loro Piano. He's got the Montclair.
So critical of me.
I'm not critical. I'm just saying.
I have the equipment.
If you want to enjoy the winter, you have to have the right equipment.
What does that mean?
You have to have the right types of warm-producing things.
Okay.
Use hand warmers if you need to.
Also, England's cold in the winter. I'm not sure how you haven't adapted.
Look, the only reason I get through it in New York is because you're promised a summer. And the summer arrives, and I can live with that. In England, it's tough. It's like this damp cold all year round that never goes away, with the promise of maybe a week or 2 in the summer of the sun shining, sort of like 2 weeks max. And every now and again, it's a heat wave. It's like 24 degrees.
Damp is worse than cold, just saying.
I totally agree. The equipment, OK. Coming up next on this programme, Jimmy Chang of Rockefeller Global Family Office, Terry Haynes of Pangea Policy, Subhadra Rajappa of SocGen. A note in my inbox just dropped in from SocGen, recession delayed indefinitely. We'll have that conversation in just a moment.
Very much so. I can't wait to hear that, because that's really ultimately what people are pricing in. Again, what does that mean for the Fed's commitment to cutting rates this year? Because we've still heard that commitment, even though perhaps they've tempered it just a little bit on the edges.
And we'll check in with our guests to see if they have the right equipment to get through the month.
I actually do. I want to know.
As
I
well.
mean, it's April's kind of week.
Equity futures on the S&P just about unchanged on the S&P 500. In the bond market, yields creeping higher right across the curve, up 4 basis points on a 10-year, 4.44. From New York, this is Bloomberg.
If we see inflation move higher, it really calls into question Powell's willingness to say rate cuts still are coming.
It wouldn't take much, I think, to push back at least the timing of that first potential rate cut.
They're telling you if things slow down, they'll cut a lot more. So they're trying to say that the risks around those 3 cuts are balanced.
It's clear that this is a Fed chair that wants to cut rates and is willing to look through some of the hot inflation data.
I think we will end up with 2 cuts this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Never insult the English weather again. Brutal feedback, sort of instantaneous.
How do people defend it? I'm just curious.
I would love to know as well, and I'm about to ask, and hopefully I'll get a reply for you. From New York City this morning, good morning for our audience worldwide. Big week ahead, CPI on Wednesday, bank earnings on Friday, lots to talk about. Let's start with the bond market on a 2-year, a 10-year, a 30-year. Earlier on this morning, new highs for 2024. Your yield right now, Lisa, on a 10-year, 4.44.
And this really raises the issue that we've been grappling with all year. At what level, at what point do bond yields create a real problem for stocks? So far, we have shrugged that question off again and again because it's been rising for the right reasons. Is the bond complex still losing value with yields rising for the right reasons for stocks to keep rallying?
The question is when. The answer is now, according to Jeff Yu of BNY Mellon, who was on this program 60 minutes ago. We'll see. Based on Friday, really strong data point. Payrolls growth, really powerful stuff, around 300K. Non-inflationary growth, that supply side story, driving equities, breaking out again. And that relationship is just evolving day by day between treasuries and stocks. And I think we're all still trying to figure it out. It's good news, truly good news for stocks.
And a lot of that has to do with the Fed pivot, this idea that the Federal Reserve came out and essentially indicated they were biased to cut, whether it's just sort of insurance cuts or, beautiful cosmetics cuts, whatever you want to call it. The question here is, are they sufficiently challenged in that thesis and that desire to reduce benchmark rates, given the data that's strong, but not necessarily inflationary in the same way? And that's the reason why CPI on Wednesday is going to be such an important day.
Is the data cooperating? Need to talk about commodities too. Gold recently breaking out to new all-time highs. Silver with a big run as well over the last week or so, up again this morning by 1.3%. And crude, new highs for the year. In fact, the highest since October. A move of close to 5%, Annmarie, last week. Just pairing those gains this morning by 0.7%.
On Brent, we've passed to the psychological level of $90 a barrel. Next, everyone is talking about potentially, can we get to 100? You see Goldman, you see Bank of America, you see a lot of notes coming out, potentially in the summer, peak driving season, these supply concerns. Can we see $100 a barrel? And this is going to be very tense, given the fact that we're in this moment right now, geopolitically, where we're still waiting for Iran's response. And then you have all the supply and demand constraints.
Does that derail the happy talk of the Federal Reserve in any way, shape or form this week in the Fed speak?
They will say no. They will say that they don't look at oil prices. Oil prices are transitory, just as bump might be transitory, and transitory was transitory. But there's this real question about how that feeds into some of the consumer sentiment and consumer expectations of inflation. We see that pretty religiously. The University of Michigan Sentiment Survey, I know you have issues sometimes with the fact that they haven't called you. Just call John, and then he'll really like the survey. But the question that I have is, at a certain point, is that going to feature in to some of the Fed prognostications?
I've looked into that before. Not to get the call, just the questions they ask.
Oh, yeah?
And I just want to speak to the people that put together that report.
You're prepared for it. You have
very
thought out
answers. 1 to 5 year inflation expectations, I'll be like 10.
So you're going to single-handedly skew the results. So the results are going to come out Wednesday, and it's going to say longer-term inflation expectations, 6.3%. Jonathan Ferro.
I walked past the garage the other day and saw gasoline at like $4, and that's it for me. 10% from here.
Okay,
is that how it works?
Okay, I understand that it's arbitrary. There's sort of an arbitrary nature. How do you sort of survey people and have this really specific number that's actually pretty relevant to the last month's number? That said, it's a good gauge of sentiment, and it sort of does feed into, this is one of the reasons why the Fed was concerned about inflation, one particular Fed meeting.
The Fed moved on this once, which I thought That was absolutely ridiculous at the time. They've moved the goalpost how many times now? How many times have they moved the goalpost? The data that matters, the data that doesn't matter. Are we on quits now? Is that the data that matters?
Look, yes, they're also inflation, et cetera. Can I just say, I feel a little bad for them. I feel bad for them. I know you're gonna rake me over the coals.
No, the floor is yours, please.
But this is a difficult economy to understand. I don't understand exactly which pieces are moving. So how do they communicate that in any kind of comprehensive way?
We all feel bad for them. Equity futures right now on the S&P just about unchanged. The price action shaping up as follows. Who are you feeling bad for the Fed?
Well, I'm just saying, I understand. I empathize with the challenge.
OK, yields up 4 basis points, 444.60 on a 10-year. Crude 86.16. Coming up this hour, Jimmy Chang of the Rockefeller Family Office ahead of a busy week of data. Terry Haynes of Pangea Policy as Congress returns to Washington. And Subhadra Rajappa of SocGen on Wednesday's CPI report. We begin with our top story. Investors bracing for a busy week of data. Jimmy Chang of the Rockefeller Family Office weighing in on the Fed's path forward. The case for rate cuts in 24 is low-quality job growth and elevated real rates, while the case for no cuts is what's the rush when growth is still above trend, markets near all-time highs and junk bond spreads near decade lows. I'm pleased to say that Jimmy is around the table with us. Jimmy, good morning to you.
Hi.
Which case is the stronger case from your standpoint?
I believe there's really no rush to cut at this point.
So you think we will get no cuts anytime soon?
I suspect there will be probably one or two after the election. For the first cut to happen, they really need a unanimous decision. And I think that's difficult to come in June or even July based on the current set of data.
You'd push it back all the way to November of this year. What would that mean for the stock markets? Because so far this year, it's handled things pretty well. We've priced in a ton of cuts and stocks are up still year to date by something like double digits. Do you think we can continue trading in that fashion?
I think the road ahead gets more difficult, probably higher volatility ahead. Part of it is also the liquidity. The liquidity support from, for the market has been extremely strong. But we're gradually drawing down the overnight reverse repo, which is the source of excess, the excess liquidity entering the market. So as you continue the QT program, continue to draw down the overnight reverse repo after the tax season, I do believe the liquidity drop gets more challenging. And this is why the Fed has signaled that they would like to start to reduce the pace of QT fairly soon.
Well, just to sort of bleed that out into the long end of the yield curve, because this has been one of the big questions. Why has that been an area that has been so difficult to gauge? If the Fed holds rates steady until after the election, does that lead to a rally in the long end? Does that lead to more conviction that this Fed can get inflation and rates back down to a level somewhat akin to what we've seen in the past?
Probably. Indeed, there's that thesis that if the Fed were to pivot too early, that raises the fear that inflation could make a comeback. So by staying tighter for longer, that's probably building more credibility to the market. But a lot also depends on the supply of bonds. I think we're always at the risk of just one more bad auction that can send yields a lot higher. And then at what point you wonder at what level is it 4.5% that start to trigger the equity to pull back. And it's not just this relationship between bond and equities. It's also between bond and gold, right? Because historically, when yields start to climb higher, real rates move higher, gold prices are supposed to come down. And yet we have been seeing this strong rally in gold price.
What do you make of that? Because there have been a number of articles trying to explain it. They all disagree with one another. What's your explanation?
I think it's a combination of the market front-running the potential geopolitical problems in the Middle East, potentially stickier inflation, and also this recognition that we just have so much debt to be issued that at some point the Fed will need to start easing aggressively with QE. The question is, how will the Fed restart quantitative easing without bringing interest rate down to zero? I think that's the question. In fact, the biggest question that reporters should be asking of the Fed at the post-FOMC meeting is that the CBO actually projects that over the next 10 years, the Federal Reserve will purchase $5 trillion of treasuries. So that's the assumption from the CBO. Someone should be asking Chair Powell, what do you think?
Yeah. Are you going to engage in another round of quantitative easing sometime soon? I think a lot of people are asking those kinds of questions, and it's a really good one. What does this mean for the traditional 60-40 portfolio? That basically the bond portion is now gold and oil and maybe chocolate and not really bonds?
Well, if you believe that the secular interest rates are somewhat higher or maybe a lot higher than what we're used to over the last decade, and potentially more volatility ahead in interest rates, then that 60-40 portfolio will not work as well. So I would suspect that you will need more diversification to get that hedging effect, looking into real assets, precious metals, alternative strategies.
What about foreign equities? Where do they fit in to all of that?
Foreign equities get more interesting when you have synchronized global recovery. We're not there yet. Foreign equities work better when the dollar is weaker. And at this point, if we believe that the ECB is going to ease imminently and the Fed may choose to stay somewhat higher for longer, then the dollar potentially will move even higher, which argues that at least in the near term, it's probably not yet time to overweight overseas equities.
Help me just make sense of this. You would expect a stronger dollar, and at the same time, you think we could get a breakout in commodities in places like gold. How unusual is that?
That's why it's been very interesting year to date. You see the breakout in gold. I think that's pointing to the market's concern with the longer run fiscal unsustainability in Washington.
Can you just help us, because we were talking earlier today about the Jamie Dimon letter of JP Morgan and how AI is this huge theme. I know you've focused on technology your whole career and just some of these technological advancements. How much do you think that that's going to reduce staffing at some of these companies? How is it going to transform some of the financial centers, given your vast experience in that area?
Initially, it's going to make us more productive. So it's augmenting, it's increasing productivity. But over time, companies will realize, well, if I can get more throughput per employee, maybe I don't need as many people. So even with expansion plans, you may not have to hire as many additional employees. So I do think over time, that raises some big issues about social benefits. Should there be universal basic income if we see more displacement caused by AI? So, but those are probably 5 years out.
So before we talk about universal basic income, when it comes to stock investing, I was going to ask a stock market question, but it really does raise some bigger social questions. Does that mean that the U.S. benefits from all of these things that much disproportionately just because we haven't been the same kind of industrial center as some of these other areas, these areas that might get sort of depopulated in terms of jobs because of artificial intelligence, that the U.S. stock market will benefit the most from some of these advancements rather than international?
We are ahead of the rest of the world. But that said, there's also the open source movement in AI, and there are a lot of smart programmers elsewhere. So it is just the competition over time, and it's also how you apply AI to each industry verticals, right? It's the business applications that will come out in the coming years. At this stage, we're just looking at the infrastructure. Who makes the chips, the computers, the servers, the software? Well, the basic level infrastructure software. But over time, it's going to be individual business verticals, and that is still yet to come.
You talk about the sugar crash in 2025. What's the catalyst for that?
It's just exhausting all the unusually high sugar, high stimulus from the COVID era. I mean, we're still benefiting from it. So just look at the overnight reverse repo as a source of excess liquidity. I mean, we have been getting net liquidity injection into the market in 2020, 21, 23, and so far in 24. 2022 was the only year with a net withdrawal of liquidity, and that's why we had a bear market. But I do suspect that if the Fed continues with QT and we deplete the overnight reverse repo, starting in 2025, the liquidity backdrop will be very challenging. At the same time, we will run out of other stimulus, such as, for example, the resumption of the employee retention tax credit. That may happen this spring. That gets paid out for the remainder of the year. Then what do we do for an encore in 2025? And also, you're looking at a potential debt ceiling negotiation in January of 25.
You describe a lot of messy things that could take place. I'm just going over everything you've said in the last 8 minutes. Stimulus exhaustion, potential for stickier inflation, go to precious metals, later start for rate cuts, UBI in 5 years. How is this Federal Reserve going to balance financial stability and price stability, given everything you've just told us in the last 8 minutes? How are they going to do that?
I don't think anyone really knows. We're really in somewhat uncharted waters. And this is why many of the traditional market indicators, the yield curve, the leading economic indicators, have not worked in this cycle, just because we have been overwhelmed by so much monetary and fiscal stimulus. We're still benefiting from it. So I think everything may be okay into the election. But beyond that, who is going to be in control of the Congress and White House? What will the policies be? So there's just a lot of uncertainties.
Do you think we could be close to this market rejecting a policy effort from this administration or the next administration sometime soon. Lisa's been talking about this for a while, the prospect of a Liz Truss moment in the Treasury market. And I think a question, we phrased it in the following way. Does Washington still have the privilege of behaving recklessly? Or are we very close to that being challenged by fixed income?
I think ultimately it will take revolts from the bond, the bond vigilantes to push Washington to be more fiscally responsible.
Jimmy, thoughtful stuff. A lot to chew over. Thank you, sir. Jimmy Chang there of the Rockefeller Global Family Office. Equity futures right now totally unchanged on the S&P 500. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. For a few fleeting moments today, Americans will turn their gaze upwards to the sun as the path of the total eclipse tracks across cities and towns from Texas to Maine. The entire event will last several hours, but the main skeptical is, of course, where day turns to night with the moon being obscured for the sun. That's only expected to last for about 4 minutes. The event has sparked a tourist boom. Areas along the path are fully booked. Meanwhile, the U.S. will lose about 30 gigawatts of solar energy with the sunlight being blocked during prime generating hours. It's roughly the equivalent of 30 nuclear reactors. The CEO of Rolex has warned against viewing luxury investments as luxury watches as investments. The CEO, Jean-Frédéric Dufour, said, quote, "I don't like it when people compare watches with stocks. It sends the wrong message and is dangerous, an interesting signal for someone who wants people to buy his watches. He sees a slowdown hitting sales of smaller watch brands the hardest." And it's a battle of the #1 seeds. UConn faces Purdue tonight in the men's NCAA championship game. The UConn Huskies are looking for a win of back-to-back national titles. The Purdue Boilermakers have a chance now to win their first ever championship. And that is your Bloomberg Brief, John.
Boiler up, Danny. Boiler up. Thank you. Up next on this program, Treasury Secretary Janet Yellen's tough message to China.
When the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
That conversation up next, live from New York this morning. Good morning. Stocks on the S&P 500 this Monday morning, and good morning to you. Welcome to the programme. Just about unchanged on the S&P. Yields are up by 4 basis points. The 10-year, 444.60. Under surveillance this morning, Treasury Secretary Janet Yellen's tough message to China.
China is now simply too large for the rest of the world to absorb this enormous capacity. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
It's the latest this morning. Treasury Secretary Janet Yellen expressing concern over China's manufacturing capacity, urging top leaders to focus on domestic demand. Her meetings were reportedly cordial. However, China's premier advising Yellen against turning, quote, economic and trade issues into political matters. Terry Haynes of Pangea Policy joins us now for more. Terry, in what way aren't economic and trade issues political matters?
Well, they always are, John, of course. And good morning, everyone. The thing is with this administration, I think the through line is that you can judge the ability to lecture is inversely proportional to the ability to actually achieve the result you want. So, everybody understands the drill over there. Yellen goes over, complains about all these policies, and essentially wants to tell the Chinese to redo their entire economic program, which they spent a couple of years coming up with. She knows they're not going to do that. They know they're not going to do that. They call a lot of the charges that Yellen made groundless, and that's a quote when it comes to flooding the world with EVs, for example. So everybody, nobody expects a different result. Firstly, not even nor in the political nor in the economic sphere.
The result seems to be tariffs, and they've been signposting it now for months, especially from the Treasury Secretary. What do you view as the timeline for these tariffs?
I'm with you all. I heard your previous discussion. I'm with you all that they try to do something closer to the election to produce a bigger bang for the buck, and they'll probably try to fold that in if they can fit with additional evidence of China helping Russia and Ukraine, which everybody knows is happening. I mean, and not just economically, Russia is effectively a client state of China, I think. So what you're going to get is I think, heightened and sharpened Chinese rhetoric just about the time we go into the general election campaign, partially in the hopes that it actually makes a difference in the election. And I don't see that much at all, frankly, but they do.
And then what would be the tit for tat that Washington should potentially be preparing for from Beijing?
Well, there's a lot of things. You know, they will. Yeah, they will absolutely tit for tat on sanctions and a bunch of other things, and they'll probably ramp up their plans to flood the United States market with EVs and all the rest, and maybe even take additional steps in places like the South China Sea in order to rattle the geopolitical cage some. I think markets continue to forget that we're in the highest geopolitical risk for 50 years, and I think they think Taiwan's gone quiet. The Taiwan issue has gone quiet. It hasn't. It's just that China is now threatening the Philippines instead of directly threatening Taiwan, so it seems quieter to markets.
Well, Terry, this is exactly the reason why I found it so interesting that President Biden is holding the first trilateral summit this week on Thursday between Japanese Prime Minister and the leader of the Philippines to talk about some sort of alliance to really counter China. How much is this directly tied to preparing for any potential retaliation to tariffs placed on China?
Oh, 100%. There are broader geopolitical issues here, and the idea of adding Japan to the AUKUS umbrella has been around for a while, and they're trying to move on that. And it's not just limited to Japan either. The Biden administration has been spending a lot of time cozying up to India. I'm not suggesting India is about to join AUKUS, but the idea here is that there's a pushback in Asia against Chinese hegemony in the region. That will continue. The economic sanctions will continue to be a part of that, but there's the broader geopolitics as well.
Not exactly an embrace of U.S. hegemony, though, is it, Terry? And I just wonder to what extent U.S. policy is being rejected by the region.
I don't think it's being rejected by the region, but there's a lot of tensions there. If you're any unaligned nation, the idea of working with the country that's closer to you to get some immediate economic benefits always is tempting, and they're under a lot of pressure to do so. At the same time, though, you've got a situation where China's been pushing the Belt and Road for some years, and that has very mixed results. And because of those very mixed results, it seems like the pendulum is moving back towards the United States and the Western alliance when it comes to wanting to establish a more independent, less China-centric position in the region for a lot of these countries.
How difficult is that kind of message before the election? I narrow in on what's going on with Nippon Steel. The president has said he doesn't want this deal to happen. The Japanese have come out and said, well, this actually means that we are stronger against China with this deal. And the U.S. is using national security concerns about China to want to block the deal, but really it's about domestic jobs. So when I talk to officials abroad, they sometimes feel that the U.S. is speaking out of both sides of their mouth. How does the U.S. combat that?
Well, how they ought to best combat it is stopping speaking out of both sides of their mouths. I do think this is something that gets the Biden administration in trouble. It's not limited to them, of course, but they do it a lot, and they do it a lot in foreign policy. You saw this in the run-up to the Ukraine war. You're seeing it now in Israel and Gaza. You're seeing it in a lot of places. What they ought to be focusing on is whether or not it convinces anybody politically, frankly. And I don't think it does. Western Pennsylvania, for example, which is one of the big battlegrounds of the election, Biden's people think they're helping their cause by being much more pro-union. But on the other hand, they're engaging in LNG bans and pauses and the like that just leave people on balance more cynical about them. So I don't think the strategies are very well thought out, either politically or economically, frankly.
You're implying there is a strategy, Terry, and I'm not sure there is one right now. Terry Haynes of Pangea Policy. Terry, thank you. Just seems to me that you do one thing to try and please Pennsylvania, another to try and please Michigan, and this is what 2024 is going to be about, Lisa, going into the election.
Which is a reason why the real litmus test, as Annmarie was talking about, is really the international allies and them sort of saying, okay, guys, what are you doing?
And if there is a strategy, I mean, that's kind of it. Coming up, Jamie Dimon out with his annual letter to shareholders with a warning about AI. That's next. Welcome to the programme. Equities on the S&P 500 totally unchanged. On the Nasdaq as well, pretty flat this morning, going absolutely nowhere. Trying to bounce on a Russell. Ugly week of losses for the small caps last week. The Russell this morning positive by 0.1%. The equity market of the S&P 500 coming off the back of the biggest one-week loss since the start of the year. If you turn to the bond market, I'll go through some levels for you. The high of the year on a 2-year this morning, 478.23, just off those levels at the moment. The high of the year on a 10-year, again, this morning, which is where we are right now, 445.41. Yields up by, Lisa, 5 basis points on a 10-year maturity.
And this is directly derived from the idea that the data is not cooperating with the Federal Reserve that seems to want to cut rates. What I find interesting is where the yields are rising. It's not inflation expectations. It's real yields. It's when you strip out inflation expectations going over the next 10 years, you're seeing that north of 2%. This is the expectation the Fed's going to have to remain higher for a lot longer. And at what point does that really start to bleed more significantly into risk assets?
It's what happens when payrolls comes in at 303,000. But Betty talked about it. What on earth was that number on Friday?
Okay, we also didn't get downward revisions. The amazing thing, and the reason why we're not talking about it, it was a perfect kind of response. The idea that you also did not get any kind of wage growth that caused real concerns or alarm bells. This is the sort of disinflationary growth that's just perfect in all sort of counts. The question's going to be on Wednesday. We get CPI, then we get PPI. Does that hold, or suddenly do you have to rethink that thesis?
Immigration means the U.S. can expand without overheating. This is what Jay Powell talked about, although I caught up with Acting Labor Secretary Julie Su, and she really didn't want to say it was immigration. She did a lot of, verbal gymnastics to say it was teenagers. That is what is driving this capacity.
They'll say things like bigger, not tighter. That's what I heard from Alan Zettler of Morgan Stanley. The economy can get bigger without the labour market tightening. Well, I do wonder, Lisa, if it is all immigration, they're not going to spend money elsewhere, given the jobs they've got. And I think it's a very tricky thing for this administration to embrace, hence the verbal gymnastics, because what's the message you're going to send? We've got a supply-side story that we're embracing because we've got a load of immigration coming across the southern border, and that's keeping wages down. Well, is that politically palatable?
Not really, if you're not getting the wage increases in low-wage jobs that you previously would have because of an increase in people who are coming in who will take those jobs for lower wages. It's a difficult moment for the administration, for the economy. From a lot of investors' standpoint, it looks like an economic nirvana. For how long? And does that last? Because honestly, you are seeing a certain level of strength with consumer spending staying in there that leads to maybe a slightly different reality.
One nugget in this jobs report that I thought was interesting was the number of multiple job holders increasing. So you have to hold multiple jobs in order to keep up with your bills. It's up 27% since the former president left office. And that is why you saw Trump come out and say, well, there's things in this jobs report that you need to look out for. That's concerning.
Things for the Federal Reserve to look out for, politically agnostic. They look at the situation right now. The market, I would say the market's got this constructive view because it believes that Chairman Powell can respond to weakness and basically ignore strength. Is there anything about the discussion that we just had that changes that?
Well, if it is people getting multiple jobs, that means that they're concerned about their well-being and their ability to pay for their bills. So that does not speak to a screaming confidence that speaks to strength, which is the reason why there is some caution, right? That, wait a second, things are going to slow significantly. The Andrew Hollenhorst view of the world. This is why the Fed is being so cautious, and the reason why Mohamed El-Erian is saying they should probably cut rates in July, even though you are getting economic data that's coming in strong.
Mohamed with us here in New York tomorrow morning, 7 a.m. Eastern time, so don't miss that. I want to turn to foreign exchange and the euro. Just quickly, the euro against the US dollar this morning looks like this. It's negative by about 0.1% at 108.25. Just want to use that as an excuse to talk about this from Eric Nielsen of UniCredit. The difference between the Federal Reserve and the ECB. Fantastic note from Eric over the weekend. The Fed says it doesn't know when exactly it will start the rate cut cycle, but it sends a clear signal about the expected pace of cuts once it starts and a view on the expected endpoint. In contrast, the ECB has all but pre-announced the first rate cut more than 2 to 3 months ahead of the formal decision, but insists the path thereafter remains virtually invisible. When you compare and contrast what's happening between the ECB and the Fed, there is a very big difference emerging right now, and just how they're approaching communication on policy.
especially given the fact that, Jeff, you said earlier that this is a live meeting on Thursday with the ECB as they come out, which raises this question whether the market is ahead of the game right now. The market is doing the job for the ECB and saying your rate cut path is a lot more concrete than the Fed's. You have a lot more to go because you've got a weaker economy, and frankly, you have a more sort of economic weakness filtering in to a more significant disinflation.
Jeff is looking for parity right now, 108.25. Under surveillance this morning, a busy week of data on tap, starting with CPI and Fed minutes on Wednesday. Thursday, we get PPI and jobless claims. UMich consumer sentiment and bank earnings round out the week on Friday. Lisa's question of the morning so far, bank earnings or data? Take your pick. Which one?
I think bank earnings, actually. CPI, if it's in line, will be treated as basically a beat. But really, bank earnings might give a sense of just how much consumer pushback there is, whether Jamie Dimon is speaking as a concerned American or whether he's speaking from some kind of concrete sense of real worry that he's seeing in the actual numbers.
But for the Fed to be able to cut, given the strong support we have in the jobs market, they need to see softer inflation. So I'm looking at the data, and Bank of America is not with the consensus. They're slightly off. They say it's 2% month-to-month rise in core inflation. They say this is much more important, this print, than last week's jobs report.
The week really begins on Wednesday with that economic data, then picks up through the week onto Friday when we get those bank earnings. Let's turn to our next story. Paramount Global is nearing a deal to merge with David Ellison's Skydance Media. Ellison and his backers have agreed to pay $2 billion for the media giant that owns CBS, MTV and Nickelodeon. The two sides agreeing to a month of exclusive talks to work out the details. Plenty of moves in this sector right now.
I'm actually surprised there hasn't been actual more consolidation. There's been a lot of talks upon talks that get broken up. Are they really going to be stronger together? Is it really just going to be the bundle that we're going back to, essentially?
Haven't we already returned to that?
Have we?
Would you like my Hulu complaint?
Please. I've been waiting all morning.
I don't get the algo. The algo is absolutely terrible. I mean, you know me. What do I want to watch Sunday? I want to watch the basketball. I want to watch the sports. What should be at the front page?
Sports.
Not there. Not there. I then have to go to a separate thing and click on the sports and then find the basketball and then watch the game. I don't get it. I have to do the same thing with the golf sometimes. It's just not there.
But what is there? That's my question.
The farmer who wants to find a wife comes top of the pile.
It's because you love also rom-coms.
You seen that?
So your algo is skewed.
My algo is confused.
It's confused
it
because
thinks that I'm multiple people.
Yes, because you watch a lot of those Lifetime movies.
That might be that.
Yeah. You watch a lot of Lifetime movies.
Only at Christmas I watch Hallmark movies.
Yeah, but you do a lot.
Shouldn't they know that it's now April and it's not Christmas anymore and you don't want to watch that stuff?
Hulu algorithm, public service announcement.
Shouldn't they know that?
Sports on Sunday.
Sports on Sunday. This is easy. Want to watch the golf? Great golf over the weekend.
Maybe it's a good show.
Fantastic finish going into the Masters this week. Let's turn the story to JP Morgan CEO Jamie Dimon. Great show, by the way. Out with his annual letter to shareholders, all about how we're moving away from urban stories to sort of stories about rural America.
And it's almost
you actually watched it.
Yeah, absolutely.
So Hulu was correct.
Just to learn. Devoting a chunk to artificial intelligence. We're moving on, guys. Saying it could be a transformational steam engine for the economy. Over time, we anticipate that our use of AI has the potential to augment virtually every single job. Shonali Basak joins us now for more. Shonali, it could be as transformational as the steam engine for the US economy. Walk us through the logic from Jamie Dimon this morning.
Well, there are a few things. We know that JP Morgan has been talking about this in their annual letter for years. We know that he has thousands of people devoted to the cause of AI. They just elevated somebody in their investment bank to play a broader role here to look at data and technology across the whole firm. When they look at artificial intelligence, they do use it in a lot of businesses already. Everything from financial advisors are figuring out how to incorporate it in a more generative way to figure out how to dole out investment advice. Remember, trading desks already use AI at scale. Now, what does generative artificial intelligence mean for the trading desks as well? Data centers, investments in data centers. So you kind of look across the entire spectrum, and certainly AI has a huge role, not to mention anti-money laundering and security concerns within a bank. If you have AI actors out there that can cause harm, as a bank, you also need to have that defense properly in place to ward those actors off.
You've been reading Jamie Dimon letters for a very long time and then covering the earnings that come out shortly thereafter. What's the relationship between the two?
So there's a few things in this letter in particular that does speak to the business moving forward. You think, for example, what he says about the expectations for First Republic. They had said earlier that $500 million worth of earnings annually would be added, and now they think that's closer to $2 billion. Lisa, if you could believe it. And on top of that, too, he also draws out his concerns. We always look on Friday, this Friday coming up, on what he's going to say about the forward look for the economy, and he gives a little bit of that in the letter today. A lot of concerns about persistent inflation and the idea that inflation could stay higher for longer. It's interesting, he balances that out in a very interesting way. He talks about persistent inflation relative to federal spending and worries about geopolitics, but he also talks about economic growth, and not only in the vein of AI being kind of as productive as a steam engine, but also when you think about how much money economies have to spend for a green economy as well. This idea that, he puts specific statistics, 70,000 electricians needed to really boost the electronification of the United States, for example. So how much productivity is needed to offset those forces, I think is a big question.
We were asking earlier, is this Jamie Dimon as Treasury Secretary, or is this Jamie Dimon as CEO of JP Morgan?
That's been the perennial question, hasn't it? This letter has always been kind of a swan song to the world. It has been Jamie Dimon's way of really weighing in on a lot of issues that impact JP Morgan, its customers, but also remember they bank clients and governments around the world. There's a whole section in the back of this letter that talks about what it's like to be a good leader, and you have to wonder if that's the handoff story. Is that the note not just to people who are looking at the qualities for the next CEO, but also his own little letter here to whoever his successor may be?
He was a little bit kinder, and he said Trump was kind of right in Davos. Then recently he went to the White House and had lunch with Kamala Harris. What is he doing in terms of politics? He's walking a fine line purposefully.
He always has, and there's a part in the letter as well where he says something I think we already know about how he's like a cold-blooded free market capitalist. And it's important to remember his economic thinking as we think about how he deals with politicians. He's always straddled the line. It's really interesting to watch him go to Congress. Now they have that annual grilling of the bankers now. They don't ask them the same political questions they used to ask about green energy financing, for example. These things, the balance has swayed one year or another, frankly, for these banks. And so he has been able to step up on things like energy financing in a way that has been unpopular at times. But guess what? A few years later, it's less unpopular, isn't it? And so you see that he kind of stands the test of time when he's fighting back on these issues.
JP Morgan shares are up 17%, more than 17% so far this year. I find it fascinating what you pointed out about First Republic and how much they've gained from that. How much are we expecting them to just consolidate their gains as the world's biggest bank, as the U.S.'s biggest bank, and really dominating a lot of areas that previously were more open maybe to some competitors?
Yeah, this whole beginning of the letter starts about the history of bank mergers from JP Morgan to Bank of America. And this idea here that JP Morgan in and of itself, by 2004, JP Morgan represented the consolidation, he says, of 4 of the 10 largest U.S. banks from 1990, if you can believe it. You remember that it had been born off of consolidation, but you forget exactly how much. And now when he's talking about bank rules as well, he's making the case for the whole banking system to keep consolidating, to ward off, this is another favorite one that I had from this, the idea that even Apple effectively acts as a bank. He's talking about all the competition they're facing from the non-bank system, and he calls out one big tech player by name.
Interesting. Apple's a bank, the airlines are credit cards. Everything's changing.
The whole idea, though, it's sort of what's your biggest competitor? Big tech is sort of the banking industry. That was sort of 3 years ago. Yep. Now it's just basically Apollo and other firms stealing their lunch. Let's hear about it.
Thank you. Great to see you. Sonali Basak there of Bloomberg. Lisa mentioned the year-to-date performance of JP Morgan. Stocks up 16%. Citi's up by 20%. Bank of America up by about 10%. All 3 of those banks having decent years so far, year to date. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief. Let's catch up with Danny Berger. Hey, Danny.
Hey, John. Crude oil is declining to start the week. It comes off of a 5-month high. Israel said it would remove some troops from Gaza, but it's still preparing an offensive in Rafah. Chipmaker TSMC will receive $6.6 billion in grants. It'll also get as much as $5 billion in loans from the U.S. That's to help it build factories in Arizona. It's a prelim agreement, but the company will build a new factory in Phoenix. That adds to the 2 facilities in the state, which are expected to begin production in 2025 and 28. The newest factory will build next-gen 2-nanometer chips. Those are essential to emerging technologies like AI and military applications. Spirit Airlines has reached an agreement with Airbus. It will defer all aircraft scheduled to be delivered in Q2 2025. Deliveries will be pushed through to the end of 26 through 31. It should improve Spirit's liquidity position by about $340 million over the next few years. Spirit will also furlough about 260 pilots effective September 1st. That's your Bloomberg Brief. John.
Danny, appreciate the update. Thank you. Up next on the program, traders trimming their rate cut bets.
And the policy mistake would be to go after 2% inflation too quickly. If this Fed is continuously overly data dependent, then maybe we don't get cuts.
That conversation up next. The S&P 500 negative by 0.1% on the S&P. We'll talk about that another time. In the bond market, yields are higher by 5 basis points, 445.41 on a US 10-year. In the commodity market, we look like this. We're just about negative by 0.7%. Crude at the moment, WTI $86, Brent crude $90 and about 50 cents. Under surveillance this morning, traders trimming their rate cut bets.
There is a slow but sure migration in markets to the view that, yes, we're not going to get to 2%. We're going to get to above 2, closer to 3, and that's going to be stable. And the policy mistake would be to go after 2% inflation too quickly. If this Fed is continuously overly data dependent, then maybe we don't get cuts. But I'm hoping that they will see through the backward-looking data and look forward. And I think we will end up with 2 cuts this year.
Here's the latest this morning. After a blowout jobs report, traders cutting rate cut bets for this year from 3 to 2. All eyes now on March CPI. SocGen's Subhadra Rajappa writing this: less is more. The market is on the cusp of looking to Wednesday to further price out a June rate cut. Strong fundamentals and sticky inflation bring into question the need for 3 rate cuts this year. Subhadra, I'm pleased to say, is with us around a table here in New York. Subhadra, good morning to you.
Good morning.
Get this question all the time. Equity markets are at all-time highs. Credit spreads are tight. We've got jobs growth at 300K. Why are we even having this conversation about reducing interest rates? Why are we?
Well, I think it's a tricky year. Coming into this year, I think the Fed thought that the economy would slow down more dramatically than what we actually saw in the first quarter. In fact, we saw a decent amount of momentum. Growth is tracking anywhere between 2 to 2.5%. And I think that they were also somewhat eager to at least start the rate adjustment policy ahead of the election so that they don't appear to be partisan. And that's what leaves them in sort of this really tough spot where the data has been performing a lot better than their expectations. And now, if anything, they might, an optimal time to cut might be in the fourth quarter, but that comes in line with the elections.
So we're taking out the cuts, we're pricing in stronger growth and maybe hotter inflation, stickier inflation. And the bond board looks like this. If we can bring it up and just go through it, Subhadra, 2-year close to 480, 10-year getting closer to 450, 30-year basically at 460. How much potential is there for high yields from here?
I think it's going to be tricky for yields to continue to rise from here because I see this current environment as being very different than what we saw in the fourth quarter of last year. Fourth quarter of last year, the Fed was biased towards hiking more by the end of the year. You were also looking at an environment where Treasury supply was in the forefront. You saw a buildup in term premium because of the increase in coupon issuance sizes. And now we're in a different environment where the Fed's bias is clearly towards easing. So they've told us that they're thinking about rate cuts sometime in the second half of this year. So that, I think, kind of mechanically puts a cap on how high yields can rise from here on. The supply picture hasn't really changed meaningfully. But that said, I think that the market's going to be biased towards lower yields from here on.
Are you saying that there isn't any data point that could come out, or cumulative data points, that would sway this Federal Reserve from cutting rates this year?
No, the Fed could very well end up not cutting rates this year if the data continues to be strong. But the bias in the bond market is going to be towards lower yields, given the fact that the market's always going to be looking towards something in the data that breaks that would cause the Fed to need to pivot and cut rates. So I think that that's really where the market's focus is going to be on.
Is it more bullish for the 10-year yield if the data underperforms or outperforms this year in terms of, this week, I should say, in terms of inflation data. If the inflation data comes in hotter than expected and it forces this Federal Reserve to hold rates higher for longer, is that more positive or negative for the 10-year?
That's actually a very interesting question, because if you think about the reaction function in the bond market, or even on Friday, the wage print was actually pretty benign. So that would kind of argue perhaps for the Fed to be able to adjust policy. But on the other hand, you got a very strong headline print, and it was really, really hard to see any sort of weakness in the employment picture. So the employment picture overall is extraordinarily strong. And then you're looking at an environment where if inflation actually starts to tick lower, will the Fed need to cut rates in an environment where everything else is really, really strong? And that's really where it gets a little bit tricky. You really need to see employment crack. You really need to see some weakness in manufacturing or other indicators that would suggest that the Fed would need to cut rates in an environment like this.
So you're predicting that the 10-year yield ends around 4%, ends this year around 4%. Are you rethinking that? Are you getting a little bit nervous as you see the strength that you just described?
The longer the Fed keeps policy higher, I think that there's a potential that that's going to feed through into the broader economy. Our call is that 10-year yields will probably start to decline towards maybe 375-ish or 380 by the third quarter as we head into the elections if the Fed hasn't cut rates. Beyond that, I think once we get past the elections, just the certainty of that should cause 10-year yields to rise. And then you start looking at things like debt ceiling, the increase in coupon issuance sizes coming into the first quarter of 2025. That should again see a rebuild in term premiums. So higher yields after the election is our call.
Andrew Balls of PIMCO just saying because of that there are better places to take duration risk at the moment. Look beyond the United States, look to, say, Europe. Is that something you'd agree with?
Yes. Because of the fact that you look at the sequencing of policy adjustments, the ECB has basically told us that they're going to be adjusting policy in June. This was not what we expected coming into this year. The expectation this year was that the Fed would go first and then the ECB would follow suit after. But now it looks like the ECB and perhaps even the Bank of England might cut rates sooner than the Fed. So in that sort of environment, I think it probably makes sense to go long bonds in other G3 countries as opposed to treasuries.
Sooner and further at the ECB? Do you think they will take rates lower than, say, the Federal Reserve?
Probably not. Again, the situation there is very tricky. Unit labor costs are starting to rise. Inflation is still very much a concern. I was actually quite surprised that they suggested or started communicating that they would cut rates as early as the June meeting. Now the market's saying, well, they'll cut in June, but then they might not have to cut that frequently thereafter. So it's really a communication, game, if you will, at this point.
This is what we're all grappling with. Are we truly in this new regime? When they start to talk about the ultimate destination, how much higher is that destination than the previous rounds of rate cutting cycles we've seen over the last decade or so? What's it going to look like?
So the destination definitely looks like it's a lot higher. We raised our terminal forecast for Europe higher to around 2.5% terminal rate in Europe. It's the same in the US. I don't think the terminal Fed funds rate is going to be anywhere close to the long run Fed funds rate, which is around 2.5%. So when the cycle ends, I think that the Fed funds rate might end up around maybe anywhere between 3 to 3.5%. And the path to getting there might be a lot slower than people anticipate.
You talk about the rising oil and commodity prices. Who's more vulnerable to that, the ECB or the Fed?
It's got to be the ECB because of the fact that they are much more dependent on energy. The ECB also looks at headline inflation a lot more than the U.S. The U.S., for the most part, is energy independent. So if anything, there are some positives that come out of higher oil prices to certain sectors of the U.S. economy, capex spending as well. So I think for the most part, the focus is at least for the ECB is going to be not just on core inflation, but also headline inflation. And to the extent that you have higher oil prices, higher geopolitical risks, I think that that's going to weigh more on European bonds than the US.
Interesting. Subhadra, great to see you. Just fantastic to catch up. Subhadra Japa there of SocGen. On a morning where we have new highs for 2024 across the curve, the 2-year out to the 30-year, the 10-year right now at 5 basis points, getting closer and closer to 450. What was the line of the sand for equity pain last week?
It was 450.
556?
Oh, 556. Well, with one person, yes, it was 556. Other people say 450. We'll see, right? We're not necessarily seeing it completely derail the equity rally, but we are seeing it in certain pockets and certainly questioning whether the rotation can persist.
The 30-year at 460, that's what got my attention last week. The small caps underperforming last week. Remember, we started last week by having a conversation about broadening out, small caps doing better. Then they got absolutely hammered, even though we had better economic data.
Because basically, those are the companies that more leveraged and that potentially could feel higher rates where they are. It's still a mystery about how resilient this economy is, whether the long and variable lags are still in existence or whether they just don't exist anymore.
Super long is what some people might say.
30 years.
Super long. Jack Manley of JP Morgan, Ellen Wald of the Atlantic Council, Kathy Bostjancic of Nationwide, and Gina Martin-Adams of Bloomberg Intelligence, all joining us in the next hour. The third hour of Bloomberg Surveillance just around the corner. Equity futures on the S&P totally unchanged. Massive week ahead. CPI on Wednesday. Q1 earnings kicking off Friday morning.
Ingredients are there for the bull market to continue in a healthy way.
We are still technically in an uptrend. Maybe there is more of a growth story at play.
We're seeing a lot of economic strength, I think more than the Fed had predicted, more than most economists had predicted.
That debate is pushing more on the side of, no, this is actually a stronger economy than we thought.
The U.S. is an economic exception among the advanced economies.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. Alongside Lisa Abramowicz, together with Annmarie Hordern, I'm Jonathan Ferro. Your equity market is totally unchanged on the S&P 500. Let's get straight to the agenda this week. Top of the pile, CPI coming up on Wednesday. We'll get the Fed minutes released on the same day. PPI Thursday, together with jobless claims. And then on Friday morning, bank earnings just around the corner. You started this conversation, Lisa, earlier on today by basically asking a question on that screen. What are you focused on? What's more important?
Honestly, it sort of depends on how it all comes out, because you can make an argument for why earnings are going to tell more of a picture that could keep this rally going. And you can make an argument that if CPI comes in hotter than expected, all of a sudden the bump has become the new transitory. And suddenly we're talking about higher inflation, a Federal Reserve that doesn't have the ability to cut rates as much.
I think given the fact that we have the jobs data behind us and that unemployment rate, a stellar unemployment for over 2 years below 4%, the biggest issue this Fed has been fighting is inflation. And we've had these upside surprises. What does it mean this week? And that's what I'm going to be really focused on.
Let's push this conversation through the bond market. Let's get to the board. Look at the 2-year, the 10-year, the 30-year. If you're just joining us, new highs for the year. On every single maturity you're looking at on the screen at the moment, we're approaching 480 on a 2-year. Lisa, up by 5 basis points on a 10-year.
Are higher yields still higher for the right reason for stocks? And I think that that's ultimately the key question that maybe we'll get some answer from if we get Q1 earnings that come in strong, and that if we get the response of good news being good news for at least stocks. This has been the key question. People have shrugged off rising yields, but they're rising a little faster, and they're rising with the idea that the Fed's going to respond. And if that persists, all of a sudden, that will be the narrative, the level at which bond yields become punitive.
2 case studies, one on Friday, one on last Monday. Let's go through them. I think they sort of speak for themselves. Monday, we had ISM manufacturing with a really punchy prices paid number. Equities didn't like it. Bond yields up. Friday, we had a really punchy payrolls figure without the corresponding punchiness in wage growth. The equity market can deal with those kind of yields. So we had 2 very different sessions where yields were up for, let's say, the wrong reasons, and yields were up for the right reasons.
Basically, if you get this sort of disinflationary growth, well, that's fantastic. But do you really have that conviction that the Fed can avoid cutting rates in the face of a jobs print north of 300,000, and this idea that there were no downward revisions that were substantial, and the fact that we are seeing people Laura Rame talking about the stickiness and services side inflation?
Just a long series of upside surprises on payrolls over the last year, the last 18 months or so. Equities on the S&P 500 this morning, just about unchanged on the S&P. We've talked a lot about the bond market, let's talk about crude. Just backing away from the highs of the year, the highs that we haven't seen since October. Crude is lower by 0.75%, $86 and about 27 cents. Coming up this hour, JP Morgan's Jack Manley on why he sees equities broadening out. Ellen Wald of the Atlantic Council as oil falls from a 5-month high. And Nationwide's Kathy Bostjancic looking ahead to inflation data. We begin with our top story, looking ahead to a busy week of data and earnings too. JP Morgan's Jack Manley saying this: things are still looking pretty good for the equity market. The US economy is doing so well that investors should be exuberant. Maybe things are a little too rich now, but I think it's entirely possible that the market sees right the way through that. Jack, I'm pleased to say, is with us around the table. Jack, good morning to you.
Good morning, John.
Why can this carry on and why can it broaden out?
Well, we're talking about, like you said, Lisa, right, the economy doing well for all the right reasons, the rate environment changing for all the right reasons. That employment report was pretty significant, John, that you had mentioned. Very strong gains, very low unemployment rate, but not the pop in wages that we would have feared. I think this week, to answer that question that you guys were talking about earlier, inflation is probably the most important thing to be paying attention to. At least that's how the market's going to interpret it. I don't think any individual inflation report sways the Fed's narrative, but inflation will kind of further this story that the economy is doing pretty well, because if the pop in inflation comes from a pop in energy prices, what we're sort of looking at right now, that is, by definition, outside of the control of central banks. The Fed can't do a whole lot about it, and so hopefully they see right through it. That's how I'm thinking about it.
So this is not because you don't want to talk about JP Morgan results on Friday. It truly is inflation. We'll talk about inflation. CPI. Do you buy into this non-inflationary growth story that so many people are embracing, not just last Friday, but over the last few months?
I do buy into it, frankly. I mean, I think a lot of what's going on with inflation today can be linked very closely to the level of interest rates. You slice and dice inflation, whether you're looking at the headline number, you're looking at the core number, you're removing the goods equation. So much of it has to do with the rate environment. It's shelter on the headline side of things. It's automobile insurance on the sort of core services side of things. Both of these things are going to be direct reflections of the interest rate environment. I think we're in this really kind of funny, peculiar chicken and the egg type situation where you're not going to see meaningful downward pressure on inflation until you see meaningful downward pressure on shelter costs. And you're not going to see meaningful downward pressure on shelter costs until the Fed lowers interest rates, mortgages come down to a more reasonable level, and supply comes back online because people are willing to step into that market. So I see through a little bit of that stuff. I don't think the inflation is something to be worried about right now.
Just to underscore what you just said, do you think the rates where they are inherently inflationary?
I think so. I mean, it's so funny because if you think about where inflation was 2 years ago, right? We're talking about 2022. We're looking at scarcity issues. We're looking at shortages of energy, shortages of food, shortages of finished goods, all of these things related to Russia, Ukraine, China still embracing zero COVID. We crushed inflation from 9.1 to 3.0 in a 12-month span, and it had literally nothing to do with interest rates, purely to do with supply chain issues getting better. Now the stuff that's here right now, that's the stickier stuff. That's the more complicated stuff. That's the stuff that's tied directly to interest rates. So I think the path from 9 to 3, easy. The path from 3 to 2, that's a lot more complicated. And hey, we've seen plenty of evidence over the last 6, 7, 8 months in those prints.
So does this leave you buying bonds and buying stocks because you think that ultimately the Fed's going to cut rates and that's going to be positive for yield since it's inherently disinflationary to cut rates because higher rates are inflationary?
Weird environment, right? Yeah. It's like a tongue twister right there. When I think about fixed income, I have to acknowledge there is a lot of short-term uncertainty about the direction of interest rates right now. We just don't really know how the data are going to continue to play out. The Fed elected to not course correct at its most recent meeting. They held on to that 75 basis point cut narrative this year, but they may change their tune a few months from now. I'm not sure. In bonds, I like the upside-downside sort of risk-reward profile there, where even if I am a little bit too early and even if yields do back up a little bit more, as long as I'm not way out on the curve, I don't really have a whole lot to be worried about. So from a fixed income perspective, it is very much a 3 to 5 year kind of sweet spot from a duration side of things, and I like the higher quality assets. I like the sovereigns. I like the higher quality corporates. I'm not really worried too much about high yield. On the stock market side of things, valuations are clearly stretched right now. I think even if you don't believe in reversion to mean, 21 times forward earnings at an index level is probably a little bit too high. But we are looking at this sort of broadening out of the recovery as the earnings story gets better for the have-nots of 2023. And I think that makes me constructive on equities too.
What does broadening out mean to you? Some people think it's sort of within the S&P 500, away from the dominant 7 stocks of last year. Others say it's look abroad. Other people, it might be going from large to small. What does it mean to you?
I'll tell you of those three, John, it's the first one. When it comes to the broadening out of the recovery, it's sort of overly simplistic perhaps, but I think it is important that investors remember that there are another 493 plus names in the S&P 500 that no one's really talking a whole lot about, that have only just now started to pick up from a price perspective, that are trading at reasonable valuations, that are punching above their weight class from an earnings contribution perspective. And as the interest rate environment gets better this year, as inflation continues to sort of normalize this year, all of these things are going to be tailwinds for those laggards of 2023. Not a big fan of stepping down in the market cap space. I think particularly when you're looking at small cap names, the debt situation there is not particularly good. The profitability situation there is absolutely abysmal. And then from an international perspective, I like the ex-US story as long as you are really careful about what you're buying out there. You know, if I buy the European index, I'm buying European banks. I'm not particularly interested in that. If I buy the EM index, a third of that's going to be state-owned enterprises. I'm not particularly interested in that either. So if you're going there, you got to be very specific.
We have a huge upswing in commodities. How do you want to potentially expose yourself to that?
The huge upswing in commodities could result in short-term outperformance from those commodity-producing emerging markets, but that is not why I own EM. I don't own EM for the commodity play. I own EM for the manufacturing play, for the growth of the middle class, the demographics, all of that leading into consumption, into production of physical goods and even services. The commodity story is not what's exciting for me about EM long-term. So if I'm looking for commodity exposure, I want to clip that coupon and maybe get a little bit of price action in there as well. I like the higher quality stuff. I even like U.S. energy producers. I think it's a shorter term play there too, because there's not a whole lot of capex. We're eventually going to have to drill more if we want to pump more of this stuff, and I'm not quite sure if that's in the cards right now. But for where things are at the moment, energy companies are making money hand over fist, and they are returning a lot of it back to you, the shareholder. So it's a pretty good environment.
Before I let you go, Jack, you said something that was pretty radical. This idea that high interest rates are actually inflationary for the economy. How many people agree with you?
I get a lot of questioned looks when I say that when I'm speaking to clients. But I think if you break it down, it starts to make a little bit more sense. I mean, in particular on the shelter side of things, you know, the Fed has raised interest rates notionally to crush inflation. That's the whole point of this thing, right? But by raising interest rates, they have made borrowing costs across the curve higher, which in turn has made mortgage rates go up considerably, which has forced any sort of would-be home buyer who can no longer afford to purchase a home into the rental market. And rental inflation has actually stayed quite robust. And rent is what feeds through into CPI. It's not home prices. It's rent, and then it's owner's equivalent rent. And so I think if you kind of tease out the connection there a little bit, it starts to make more sense. But first blush, I get a lot of, huh, you sure about that kind of views?
We heard that from Sophus as well, from over at Oppenheimer. He was talking about the idea that that is really the key to bringing home prices lower, is potentially lowering mortgage rates.
He was telling us about his 10% mortgage, wasn't he?
$200,000. We felt really bad for him.
2-bed with a terrace in Manhattan.
Oh, poor guy.
In Manhattan, exactly.
Seriously. Jack, good to see you.
Great
Thank
to
you,
see
sir.
you.
Jack Manley of JP Morgan. Equities right now on the S&P just about unchanged. Let's get you some stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. For a few fleeting moments today, Americans will look up to the sun, hopefully with glasses on, as the path of the total eclipse tracks across cities and towns from Texas to Maine. The entire event itself, it's going to last for several hours, but the main spectacle is when the day turns to night and the moon is obscuring the sun. That will last only for about 4 minutes. The event has sparked a tourist boom, and areas along the path are fully booked. The South Carolina Gamecocks are the national champions. They defeated the Iowa Hawkeyes 87-75 in the women's NCAA title game. It's now the third South Carolina national title in just 7 seasons. They're also the 10th D1 team in history to complete an undefeated season. The real highlight, though, was Iowa's Caitlin Clark. She ended her career with a whopping 3,951 points, leaving as the all-time leading scorer in both men's and women's college basketball. Now, on the men's side, it's a battle of the #1 seeds. UConn faces Purdue tonight in the men's NCAA championship game. The UConn Huskies, they're looking for back-to-back national titles. The Purdue Boilermakers now have their first chance for their first ever championship. And that is your Bloomberg Brief. John.
As many of you know, manager is a Purdue grad, which means boiler up, boiler up. I think we just say that repeatedly, right?
Every time you
get
say that, I'm
extra
just
points
thinking
for
to
that.
myself, does that actually work? Please write in and let us know.
Something like that. Great weekend of sports. Liverpool dropping points. What's better than that?
Really?
What's better than that?
Okay,
What's better than that?
That's terrible.
Up next,
You're mean.
the oil rally, taking a breather.
The Saudis would love to have a $90 price, not going to 95 or 100, and not going much below that. But you can't really manage a market to that degree. $90 would be the perfect number if it would be stable for a long period.
That conversation up next, live from New York. This is Bloomberg. That was good. That was good. All right. Equities look like this on the S&P 500. Equity futures just about positive by 0.05%. Yields up 6 basis points. The 10-year 445.81. Under surveillance this morning, the oil rally taking a breather.
The Saudis would love to have a $90 price, not going to 95 or 100, and not going much below that. But you can't really manage a market to that degree. So they have a much better, not cynical understanding, but a real deeper understanding now of the dynamic effects between financial flows in and out of markets and the balances. $90 would be the perfect number if it would be stable for a long period.
Here's the latest this morning. Oil falling as Israel removes some troops from Gaza, but still above $90 a barrel on Brent. And in World of the Atlantic Council writing this, for OPEC, the $90 a barrel level can be a difficult spot. It's high enough that consumer nations get upset with prices and want them lower, especially during periods of high demand like the summer. It's also harder to maintain adherence to quotas because producer nations have the opportunity to make more money with higher per barrel prices. Ellen, I'm pleased to say, is with us. This line that came from Ed Morse, Ellen, $90 would be the perfect number if it would be stable for a long period. Ellen, you're making an interesting point. How difficult is it for that number to be stable for a long period?
Yeah, I think it's very difficult to be stable for long periods because once that number seems like it's here to stay as opposed to just a spike due to, say, a geopolitical occurrence or an environmental occurrence, you've got you start to get really, really uptight and antsy consumer nations. India is going to be upset. China is going to be upset, not to even mention the Biden administration, which is going to be very upset if we see this going on all through the summer. That could damage their election chances so much because for some reason, American voters really associate gasoline prices with the political party that's in power currently. There's really there isn't really a reason for this, but it's really a really prevailing element amongst the American electorate. And so if the $90 stays, it really could become a problem. And OPEC is going to have a very, very hard time resisting the pressure both to put more barrels on the market, especially Saudi Arabia, that's already got these extra voluntary cuts beyond what they're required to do under their quotas.
So we're going to have to, at some point, it sounds like you're saying, see supply either come from the Saudis or potentially an SPR release. At what price level do you think the kingdom steps in?
I think that they don't step in necessarily at a price level, but they respond to pressure. I think if they see prices going much above $90 a barrel, then I'd see them step in. I think that they are also looking at their demand. They're going to want to see what kind of orders they're getting from Asia, especially because they don't want to see that drop off. And if it looks like their oil is getting too expensive for their Asian customers, I think we would see them potentially start to put together a price increase at the next OPEC meeting.
Okay, so let's talk about the potential.
I'm sorry, a production increase.
Let's talk about the potential use of the SPR. We are well below the highs during the Obama administration, but we're still at, I think, 360 million barrels that this SPR holds. The Biden administration could have a meaningful tap of the SPR before the election, no?
Well, I think that's a really difficult thing to do because, first of all, they've already tapped into the SPR earlier, and there was a lot of pushback, especially because a lot of that oil got exported to China or to other countries, and it wasn't necessarily used domestically. And the purpose of the SPR is not to just lower gasoline prices because they happen to be too high or they happen to be too high than what they prefer for an election. The purpose is really to have this in store in case there is a geopolitical event that is preventing oil from getting to the United States or to other countries, or there's a hurricane, for example, that could take out production in the Gulf of Mexico. We saw SPR releases after there was a significant time where production in the Gulf of Mexico was out due to a hurricane. And if the Biden administration starts releasing the SPR just because gasoline prices are a little too high, then they're setting both a difficult precedent because then when are they going to refill this? They've really got to refill it constantly if they're going to be using it. Plus, the summer months are coming. Hurricane season is coming, and hurricane season is strongest in September and October, which is going to be right before the election. They may want to save the SPR basically in case they need it for that time.
Ellen, when you are a net energy exporter, what is the appropriate level of the SPR? What do you think it should be?
That's a really good question. I think that question is kind of not so relevant because we're technically members of the IEA, and the IEA has a certain, in order to be a member, you have to maintain a certain amount in your SPR because a certain amount of your consumption. So I think it's a tough call. You really should maintain, I think, more than you would think, because you don't want to screw up all your exports by suddenly deciding, oh, hey, we got to halt exports because we need this domestically. You don't want to have to do that. And so it's a good idea to maintain a good amount in your SPR to be used in the event of some kind of embargo, stoppage, natural disaster, and not to just use it because gasoline prices are 50 cents per gallon higher than you think they should be.
It reminds me of the conversation about the Fed, Ellen. We talk about what the Fed should do. We need to talk about what it will do. At the end of the day, you and I could talk about this. We probably agree on the same things regards to the SPI and how it should be used. It's how it is being used that I think is more important here. Do you anticipate they will be draining that SPR going into the election?
I think that really depends on where oil prices go. I think if OPEC decides to increase production at the June meeting, there's a lot less likelihood that they'll drain the SPR. They're not going to refill it until it's below, I think, $75 a barrel. But if OPEC does increase production, I don't think we're going to see that. They'll also probably try to push American oil producers to increase production, which is something that I don't think they're going to be very receptive to, given how much pressure they've had basically on every other respect and how much vilification they've had at the hands of the Biden administration. They're going to do what they think is best for their business at this point, regardless of what the administration says.
There are 2 points in there. Saudi Arabia's response to oil prices, especially heading into the election, and U.S. producers. Let's start with Saudi Arabia, since you wrote the book on the Saudi family. How willing are they going to be to help President Biden heading into this election?
That's a good question. I think that they're not going to be that willing, and they're going to want a lot in response. That doesn't mean that they are totally unwilling, especially if they think it's a good idea for the market. So if they're getting pressure from the Biden administration, and they're getting pressure from Iraq and Kuwait and other producers that want to increase output, plus, they see, look, $90 a barrel. Well, if it stays that, if it goes above that, that looks like it could be heading to 100, which I do think seems unlikely, but is absolutely a possibility, then they're definitely going to want to increase production to stave that off, because once you hit higher than that, you see demand destruction, and that's definitely something they don't want to get. They want to keep their Asian customers happy. They can also keep the Biden administration happy and get new defense treaties, new, military equipment sold to them. If they can get concessions on other things that they want, then I think it would be a win-win for Saudi Arabia, especially if they can portray it as a kind of big PR coup for them.
When it comes to the domestic picture, how much more can the U.S. produce? How quickly can they act as a swing producer after already pumping 13 million barrels a day?
So that's a really good question. I definitely think production could be higher. The question is that something that they think is a good idea? Now, the U.S. isn't really a swing producer because its oil production is not centralized. We've got all sorts of different companies doing what they think is best, and what they've been saying is best for them for a while is not to drill that many more wells. Yes, each well, they're getting a lot more productivity out of those wells, but they're not interested in spending a lot of money drilling new wells, especially if interest rates stay high and inflation continues. They're not going to want to spend more money. They may try to get something out of the Biden administration, like approvals for new drilling in the Gulf of Mexico, for example. It's possible that they could use that leverage, especially if they think that Biden is going to be reelected.
Interesting. Ellen, thank you. We've got to leave it there. Ellen Wald there of the Atlantic Council and the author of Saudi Inc. Crude this morning down by, let's call it 0.75% on Brent, $90 and about 50 cents. WTI, 86.31. Just got a fascinating note from Goldman Sachs on the economy. Take a listen to these numbers. Recent immigrants are disproportionately young or prime age and come mostly from Latin America. Here are the numbers. We estimate that net immigration surged to roughly 2.5 million in 2023 versus about 1 million per year before the pandemic, boosting labour force growth and potential GDP growth as well.
That's what we keep hearing from every economist. Torsten Slok over at Apollo put out a chart showing just how much of the new jobs, how much of the employment has come from new arrivals to this country.
We'll talk about the economics of that in just a moment. We'll catch up with Nationwide's Kathy Bostjancic, looking ahead to inflation data this Wednesday. Live from New York, this is Bloomberg. Equities on the S&P 500 positive here by 0.1%, 60 minutes away from the opening bell, just around the corner, just a little bit of a lift on the Russell by 0.4%. More than a little lift in the bond market. I think we're up something like 60 basis points year to date on a 10-year. Close to that level, up another 6 basis points this morning. 445.81 on 10s. If you are just tuning into the price action this Monday morning, new highs right across the curve for 24, including at the front end on a 2-year lease. So getting closer to 480.
And people pushing back just how much the Fed can cut rates this year, given the incredible employment picture that we're seeing. It is still viewed, though, as positive. I want to just sit on the fact that we're seeing yields at the 2024 highs, and yet stocks still eking out a gain, that the downdraft last week was so difficult. Okay, we haven't seen a down day of more than 2% going back to February of 2023. This is a completely entrenched kind of feeling of optimism, and this bond market hasn't been able to stymie it.
303 was just a blowout number on jobs on Friday. And does that sound consistent with rate cuts? Well, Mike Gapen of Bank of America says it is. While exceptionally strong, the employment report is consistent with the Fed starting to ease this year in June. The Fed has embraced the supply side. A jump in labour supply can allow for stronger growth without overheating effects. That's the story they're all embracing on the FOMC.
And then you had Jack Manley of JP Morgan coming on and saying, actually, maybe higher rates are actually inflationary, not deflationary. Maybe the Fed is actually contributing to inflation with rates where they are. And he is not alone. People looking at this and saying, John Stolfus, that if you lower rates, then actually more supply is going to come onto the market in terms of housing and you'll have prices go down. This is how uncertain the moment we're in. We don't even know what restrictive rates means at a time where some people are saying it's actually stimulative.
I think Jack's just in my camp and just wants to buy a property here in Manhattan, wants some supply, wants rates to come down.
Yeah, is that what you think?
Yeah, I think so.
And you think that it's
I think
going to
a lot
lower
of people
prices?
from a certain demo, from a certain generation, are all thinking the same way about interest rates and housing prices.
Yeah, but it tells you something. But do you think it's going to lower prices for you? Are you going to get that $280,000, two-bedroom apartment with a deck?
With the roof deck.
With the roof deck.
With the roof deck for 200K?
In Manhattan.
God, don't the boomers drive you nuts? on this issue.
Well, it is a different
friends
time.
with a lot of boomers, best friends with TK still. But on this issue, I get really wound up.
Although he still rents.
He still rents, yeah.
So, not everybody.
missed the boat on that one.
I know. Oh, big time. Can you imagine? He's got stories about that. He can share them with you when he wants to. Let's look at commodities. Brent crude and WTI, they look like this. Brent crude is negative by 0.8%, $90 and about 50 cents. AMH, Ellen Wald, great, just 10 minutes ago. What stood out for you?
What stood out for me is this line in the sands almost. She's talking about this $90 a barrel where, especially as we potentially have more upside risk with the geopolitical concerns, the pressure she's talking about that's going to come on Saudi Arabia. And she made a great point. It's not just from the United States of the world. It's from China. It's from India. And potentially, if more pressure is coming from Asian countries, maybe that gets uncomfortable for the kingdom.
Crude down 0.75%. Under surveillance this morning, Treasury Secretary Janet Yellen delivering a direct message to China. Focus on domestic demand. Yellen framing China's excess production as a risk for the global economy, saying it poses, quote, significant risk to workers and businesses in the United States and the rest of the world. These complaints aren't new. They're old. They're really, really old. And I just wonder what the purpose of them this time around is, if it's not to just lay the groundwork for more moves on tariffs later this year.
Well, and Annmarie can get into the tariffs, and that's what a lot of people are expecting. The data, though, behind it's fascinating. And Brad Setzer of the CFR came out with this chart showing how exports from China of electric vehicles and lithium-related batteries have skyrocketed. They've grown exponentially since the beginning of the pandemic, and it highlights how it's shifted. It's moved away from computer parts to these areas where the tariffs are likely to be put on. So there is this new urgency that suddenly they feel like they have to get ahead of the election at a time where there's already growing sense of unease without China.
They just keep signposting this, and Yellen's line here, I've made clear that Biden and I will not accept that reality again, talking about decades ago when it was cheap steel coming on, an overcapacity of steel on the U.S. market, what that meant for U.S. jobs. But they are going to wait, I think, until right before the election, the best bang for your buck. But interesting, Goldman has a note out today about actually how high inflation can go if we get even more tariffs on China, not EVs, a blanket 60%, if the election goes the other way and it goes to Trump.
Complaining about the loss of American jobs is politically maybe the right move. Complaining about cheap goods right now, given how everyone feels about inflation in this country at the moment, I'm not so sure about that path politically, not economically, going into the election.
People want things to come down, prices to come down, inflation. But this is the reason why it's so difficult to have a real conversation, because all of these issues are nuanced and they all have multiple parts. And there isn't a level of consistency where you can say, look, we're going to have to accept higher prices if we want more made domestically and if we want to have a concrete policy of self-sufficiency on the industrial side. If they want to make that argument, it is going to come with higher prices and it's going to come with certain other sacrifices. That's a conversation people don't want to have.
I know it's tough to do the counterfactual, but on this issue, they don't want to talk about this. Let's imagine that union membership was level with where it was in the 1970s. Can you imagine how different this inflation story would be? You had Jack Manley sitting there moments ago, and Jack was talking about how quickly inflation's come down from, say, close to double digits to around 3 currently. Do you think that would have been as easy if we had union membership where it was back in the 70s? And the path-through from headline inflation would have been direct right into wages? Right into wages. Can you imagine what that would have been like?
It's an interesting question because it also speaks to the globalization that led to a lot of the disbanding of some of those unions and the lack of industrial output by this country. Honestly, it's a lot of questions and a lot of people are thinking really big. What kind of new era are we entering? Is it one that's more weighted to labor? Is it one that's more headed toward industrialization, but with a heavy component of automation and AI?
Be careful what you wish for. It's easy to say I'm the president of the unions and go there and sit with them and campaign. But if you had membership levels where it was in the 70s, the cost of doing that would have been a lot higher for this economy. And this time around, of course, membership rates are a whole lot lower. The pass-through, of course, less obvious. Anyway, you understand the story. Let's turn to JP Morgan. The CEO, Jamie Dimon, out with his annual letter to shareholders, devoting a large part of it to AI. Dimon saying the technology will have wide-reaching impacts across all industries. Dimon also issuing a warning on the economy, writing, quote, these markets seem to be pricing in at a 70% to 80% chance of a soft landing. I believe the odds are a lot lower than that.
Let's hear what he has to say on Friday. That's what I have to say. Is this typically
record
the type
numbers?
Right. Well, this is exactly it. I mean, how often do you hear the sort of gloom and doom, and then it's sort of, we just, made $2 billion with the acquisition of First Republic. So,
but a lot lower than 70, 80%. So what? 50%? Is it?
I think we get confused with Jamie sometimes. When I listen to Jamie Dimon, I hear a risk manager talking about a range of outcomes, a range of possibilities, and I think we're too quick to compare them to sort of like, this is the economist, this is his base case, and it keeps changing. I think from a risk management perspective, what would you worry about? That it's not going to be a soft landing, that maybe rates have to stay higher for longer because inflation's going to be stickier. If you're a bank CEO, I can imagine they would be things that you spend a lot of time thinking about.
And you know what? People want to hear what he has to say. He runs the biggest bank in this country, and people want to understand his view on things, which is the reason why we're hearing a lot of major executives talking about the debt, talking about the deficit, talking about concerns about a Liz Truss moment, not in those words necessarily.
Abramowicz concerns.
But, part of this is because of dysfunction in D.C. So who's going to take that home and actually have the rational business case for things other than the business leaders? I mean, at a certain point.
Yep. Who's the business-friendly party? at the moment. Had that conversation just last week with a lifelong Republican who had his doubts as well.
There isn't a consistent policy because of the protectionism on both sides of the aisle and the fact that there is a sort of populist bent. If you think of a business perspective, they're getting concerned about the deficit, and it's real. When I talk to different investors, this is what keeps them up at night. It's not just lip service, it's the auctions.
Couldn't agree more. It's the auctions. Big, big auctions, as Bramo repeatedly says on this programme. Coming up, we'll be talking about this. A busy week of data. US inflation data on Wednesday, the latest ECB decision on Thursday, and the big banks kicking off earnings season with JP Morgan, Wells Fargo and Citi set to report on Friday. Kathy Bosjancic, the chief economist at Nationwide Mutual Insurance, joins us now for more. Kathy, I want to talk about this supply side story, which is almost like code at the moment for immigration. I want to talk about these numbers from Goldman Sachs because they are just stunning numbers on immigration. We're talking about millions of people coming into this country, 2.5 million in 23, net immigration. That's the number that Goldman have got versus about 1 million per year before the pandemic. Kathy, how important is that as a theme to ensure that we see numbers like the numbers we saw on Friday?
Well, good morning, John. Happy to be with you. It's critical, right? I was saying a year ago, you can't continue to have, 300,000 per month job gains with the labor force we had, right? How low could the unemployment rate go? We just don't have enough available workers, and immigration really changes that story completely. If indeed we're having, closer to 3 million, which is now estimated by the Congressional Budget Office for this year, compared to 1 million, as you said, that's a huge game changer. And that means that employment gains can be, 100,000 more, right, per month than we thought before. So it's a really big game changer. It does increase the supply side of the economy and helps explains why this expansion just continues.
Don't we have to think about how sustainable this actually is, Kathy, that if you get a change in the White House, that this might change quite quickly?
Indeed. It's something that we are, looking at when you ask and try to, handicap the election and the different outcomes. That could be a big game changer. We know that if there's tough talk on immigration, it could also, under the previous Trump administration, it also deterred legal immigration. So maybe some of what, we're seeing could be reversed. And we'll have to watch that right as we go forward. But for now, we are seeing that, at least through this year, the immigration numbers look very, very high.
Kathy, there's an argument to be made that because of how big the numbers are and how much of that is being taken up by new arrivals to the country, that it's masking an underlying kind of stasis in the labor market, that it's masking sort of churning that is slowing down. Do you buy that argument that potentially it's masking the idea that this economy is going to slow substantially in the second half?
So I think it's less likely now. I think, what you're seeing is the companies are backfilling jobs they would have otherwise filled, right? It's not just getting back to the pre-pandemic level, but it's getting back to the pre-pandemic trend. And the fact that you have more workers and you're generating more income, that means more consumption. So it can continue to support itself on the upside. So we see it less likely that we see this big downturn in the second half of the year. Earlier, we were seeing signs of that, right? If you went back, 4 or 5 months ago, we were seeing a big concentration of jobs. What I would say is in more the non-cyclical sectors, but that has really changed over the last couple of months. We've seen it broaden out quite nicely. And I don't think at this point the momentum's so strong. I don't see that happening now the second half of the year.
So let's fast forward to Wednesday, Kathy, this idea of immaculate disinflation or growth with disinflation ongoing. What would you have to see in Wednesday's CPI numbers to challenge that concept?
Yeah, so we're, everyone's going to be, very focused, right, on the core number particularly. But we're coming up with our estimate, 0.3, both total and core. I think it's not so, as long as that number isn't 0.4 or higher of the core, I think you could still have the narrative because we have 4, in addition to that, you have 3 inflation reports before July that the Fed meets at the end of July. I think if you get start to get 2/10 prints on months going forward, that still leaves the door open for them to cut rates in July. But we really do need to see that slowdown. I think there are factors underneath in it that, with housing you spoke about. I mean, our models still suggest rental inflation should slow. And then if you look at other categories in the supercore, transportation services, we think some of that real frothiness starts to slow. So we're still encouraged. And I do think that, the Fed, they, get this. They may get that supply side increase and still see inflation slow.
I like to marry these two stories. We had an uptick of multiple job holders, individuals who have to have multiple jobs to just pay their bills. How much are we seeing higher inflation keep fueling a stronger and even tighter labor market?
Yes, so great point in that there is a dichotomy still, right, in our economy, and you could argue it's gotten worse. If you're reliant on, let's say, variable rates, right? Like we're seeing in the housing market, the existing homes market is still stalled. It's completely paralyzed. And then if you look at the workers, yes, if interest rates are facing higher credit card bills, and they have to take multiple jobs, that only adds to the pressure there on them. But they can continue to spend and borrow, but there is pressure there. There's vulnerability. And let's put it this way, many consumers are not prepared if we get a labor market slowdown. Looking ahead, again, I think that's more 2025 story at this point.
What do you think of JP Morgan, Jack Manley's point that because rates are so high, that this is putting so much pressure on the housing market, and shelter makes up the wide swath of the inflation number that's been hard to come down?
I think there's a good point there, although what we have seen is the new housing market and housing starts construction has been stronger than the existing market. So I would say that, builders somehow are finding a way, either they're buying down the mortgage rate or there's other incentives going on, or maybe we have more cash buyers, but we are seeing new supply come on. That's what we really need to see. Now, it's not great that the existing home market is stalled because I think that restricts mobility across the country. But that said, I think that overall, yes, all else equal, we need to see lower rates to get the housing market up and running. And I think even on the new housing supply would do better if rates were lower.
Kathy, Jack Manley's point was also that high rates are actually inherently inflationary. Do you believe that?
No, not. I can see the argument for the housing market. I think other than that, no, that's not. I don't think that's true. I think higher rates do depress activity, and when that happens, less orders, right, for companies, and they're going to feel the pinch, and they're not going to be able to raise rates as much, and it tends to be disinflationary.
Kathy, can we just finish on immigration? I'd love your thoughts on this, and let's stay clear of the politics because I know you want to focus on the economics. It's welcomed in the labour market for the following reasons. You embrace the supply side and somehow it keeps a lid on wages and more people come into the workforce. And we can talk about this another time, whether that's actually a good thing because it keeps a lid on wages. What I struggle with from the perspective of this being non-inflationary growth, if we're talking about net immigration of 3.5 million versus 1 million, aren't those individuals getting jobs and spending money elsewhere? Aren't they competing for houses, pushing up rent? Kathy, can you really say that's non-inflationary growth away from the labour market?
Excellent point. And I do think there it's the housing market where you have the largest issue, right? I think that there has to be a response on the supply side. And you're right. If they're working and spending and have jobs, they need housing, and that will put pressure. I think eventually, you get that supply side response on housing. I think away from, that will help greatly, but we need that, and that takes time. But I think away from housing, I don't necessarily see it as inflationary. As you said, wage growth has been moderating because of the supply side. But we are in I agree with you, John, very unique period in that we lack the housing supply. And that really goes back to the great financial crisis, right? Pendulum swing so far the other way. We've seen a restriction and depressing effect on housing supply, and it's catching up with us right now. So for now, we're in that conundrum, but I would suspect that away from housing, you see a pretty disinflationary effects still in place.
Interesting. Kathy, thanks for the update. Appreciate it. Kathy Bosjanskic there of Nationwide. Going into inflation data on a Wednesday. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs strategists say that Europe stocks are likely to outperform the U.S. in the next year. A team led by Sharon Bell cited a lot of factors that included a manufacturing upswing, a pickup in global PMIs, and the ECB rate cuts that they say will begin in June. Strategists are also expecting to see a better performance for financial, energy, and consumer discretionary stocks specifically. Chipmaker TSMC will be receiving $6.6 billion in grants. It's also going to get as much as $5 billion in loans from the U.S. to build factories in Arizona. It's a prelim agreement, and under it, the company will build a new factory in Phoenix that adds to the 2 facilities in the state, and production is expected to begin in 2025 and 28. The newest factory will be building next-gen 2-nanometer chips. Those are the ones that are essential to technologies like AI and have heavy military application use as well. Spirit Airlines has reached an agreement with Airbus to defer all aircraft scheduled to be delivered in the second quarter of 2025. Deliveries now will be pushed to the end of 26 through 31. That should help to improve Spirit's liquidity position by about $340 million over the next few years. Spirit will also be furloughing about 260 pilots effective September 1st. In that, they cited aircraft deferrals and grounded aircrafts due to engine availability issues. And that's your Bloomberg Brief, John.
Danny, thank you. Up next on this program, looking ahead to Q1 earnings.
Our attention is really shifting to the earnings season, which is upon us. Ingredients are there that even though we might see some, breather here and there, that ingredients are there for the bull market to continue in a healthy way.
A conversation up next. The opening bell 39 minutes away to kick off a brand new trading week. Equities trying to bounce by 0.2%, attempting to bounce from the biggest one-week loss on the S&P since the start of the year. Yields are higher by about 4 basis points, 4.44 on a US 10-year, 4.44.60, and crude pulling back by 0.9%, $86 and about 15 cents. Under surveillance this morning, looking ahead to Q1 earnings.
Our attention is really shifting to the earnings season, which is upon us. Reality is this higher for longer interest rate environment should be positive for financials too, and tech is still holding in there from an AI demand. And so we think that the ingredients are there, that even though we might see some, breather here and there, that ingredients are there for the bull market to continue in a healthy way.
Earnings season kicking off this week with big banks leading the way. JP Morgan, Citi, Wells Fargo, all reporting their latest results before the opening bell on Friday morning. Gina Martin-Adams of Bloomberg Intelligence joins us now to discuss. Gina, great to catch up with you going into those numbers. What are you and the team looking for Friday morning?
Yeah, I think it's going to be a really interesting earnings season, but not necessarily because of financials. So I hate to throw cold water on the sort of financial story. The group has been in a pretty consistent, slow earnings recovery, but there's just more exciting things happening in the rest of the index. So if I were to say what to look for the earnings season at large, financials usually set a pretty positive tone. They have for the last several quarters. But really what we're looking for is revenue growth overall to surprise expectations. I think that revenue growth has gotten sort of a bad rap, and analysts have been somewhat scared, frankly, to increase numbers for revenue expectations, but revenue continues to beat expectations. Volume sales even continue to beat expectations despite the on-again, off-again macro weakness. Analysts have really not adopted the revenue trend. So I would say overall, expect a beat on top-line revenue growth for the S&P 500 at large, in particular driven by tech and communications, but also generally driven by consumer sectors. Yeah. I think we might also see a pretty big surprise in the commodity sectors where we've seen stabilization in commodity prices, but analysts are still expecting double-digit declines there.
Just quickly then, are we looking then at Wednesday, really the earnings kickoff with Delta earnings that are coming out before the opening bell?
Yeah, I think the most important part of earnings season, Lisa, I know that we're all anxious to get it going with this week, but I actually think the most important part of earnings season won't come for a couple of weeks. We'll start with a slow roll into industrials and financials. Then we really move into some of the tech, communications, And finally, at the end of the season, you get the bulk of the commodity sensitive space. So as much as we're all excited about the next week as we enter the season, the real ramp up and probably the most interesting components of earnings season won't happen for another week and a half, 2 weeks.
We're just trying to get excited about it, Gina. Thank you. May 22nd, NVIDIA. Basically, it's May 22nd, NVIDIA.
I actually am interested in Wednesday. We get Delta earnings, and that's the perfect intersection of consumer discretionary plus commodity space. I mean, it's going to be incredible.
OK, May 2nd, Apple, if you're interested.
April 10th.
April 10th. I think it's May and tech, right?
Yeah, May and tech.
For all the talk of this
important.
broadening out,
sure,
the focus is elsewhere.
Can they deliver the same kind of gangbusters projections? Is the AI pipe all that it's made out to be at a time when people are saying it could take a while to actually get rolled out?
Wednesday's the only thing that matters. March CPI is going to eclipse, pun intended, by Subhadra and her note, all other data this week.
Will that eclipse Delta earnings?
Yes.
Yes? No?
Who knows?
Okay.
I mean, honestly, if it's in line, then we're going to be talking about the thing that never happened.
I guarantee we barely talk about Delta earnings on Wednesday.
Is that basically
right,
what you're telling me? You're just telegraphing in advance. You mentioned that.
Unless they've offered you discounts of some sort.
It'll be like a sort of hinge on my seat. I'll just get shoved backwards.
It's not a game show, Ramo. Real deal, this. Really serious stuff. Coming up tomorrow, Stuart Kaiser of Citi, Mohammed Al-Aaron of Queen's College, Cambridge. He'll be joining us around a table. We'll speak to Megan Draper of Barclays and Seth Carpenter of Morgan Stanley. Fantastic lineup for you tomorrow morning. Going into the opening bell, about 34 minutes away. Equity futures attempting to bounce with bond yields at new highs for 2024. Your 10-year 4.4480 higher by 5 basis points. Live from New York City, this was Bloomberg Surveillance.